Hello, good day, good afternoon, everyone who's joining us in the session now. Great to have you with us in the workshop. So we'll give everyone a moment just to join us in the session. Make sure you've got your audio settings sorted and we'll get started in just a moment. Whilst we're waiting, feel free to introduce yourselves in the chat if you'd like to say hello and let us know who you are and what organization you're joining us from. And we'll be getting started momentarily. I see lots of you joining us at the moment, which is fantastic to see such a good turnout. So many thanks and welcome everyone. And we'll give it just maybe 30 more seconds and then we'll start the session. Thanks. All right, I see we already have lots of attendees and lots to talk about today as well. So I think let's get started. So welcome to those who may have just joined us. It's great to have you in this half-day training session on applying the IFRS Sustainability Disclosure Standards. So I'm Fiona Quinlan from the UN SSE Academy team, and it's great to be here with you all today. So this training program is truly a really collaborative effort between a number of different organizations, really driven by that demand we're seeing for more capacity building globally to support the implementation of the IFRS S1 and S2 standards. So firstly, I'd like to say a big thank you to the IFRS Foundation for supporting us with this program and the IFC, part of the World Bank Group, as well for their participation and collaboration on this initiative as well. And of course, a big thank you to all of you for joining us in the training session today and taking that time out to be here. And a particular thanks today to the Indonesia Stock Exchange for hosting us in our training session, to Ronnie, Tuku, and their colleagues who have helped us organise this. It's fantastic to be here with you with IDX. So on that note, I'm pleased to introduce our first speaker who'll be giving us an opening to the session from IDX. So it's a pleasure to introduce Tuku Fahmi Arianda, who is Head of Listed Company Regulation and the Services Division at IDX. So many thanks again for joining us, and I'll pass over to you for your opening remarks. Thank you.
Okay, thank you, Fiona. Ladies and gentlemen, a very good afternoon, everybody. First, I think I want to mention honorable guest and speaker for today's event, Miss Fiona from UNSSE, and Miss Louise Guthrie, also from UNSSE. And also we have Mr. Robert from IFRS and Miss Bella Cheng from IFRS, and also Miss Kate Lazarus from IFSG, and all of the representative from listed companies and from exchange members and all distinguished participants present today. So very good afternoon and welcome to today's workshop. Today's workshop is about on IFRS sustainability standards. First of all, let us express our gratitude to the Almighty God for granting us the opportunity and good health to gather today's event. On behalf of Indonesia Stock Exchange, I would like to extend my deepest appreciation to our distinguished guests and speakers from the United Nations Sustainability Stock Exchange and also from the International Finance Corporation. And this event is co-hosted by IDX and UNSSE as a part of our joint effort to strengthen the ESG and sustainability ecosystem in the Indonesia capital market. Our distinguished guests, as we are well aware, sustainability and ESG reporting have become a global priority. On a global level, the IFRS Foundation through the ISSB already issued IFRS S1 and IFRS S2 since June 2023. In Indonesia, Indonesia Institute of Accounting, or IAI, has officially adopted these standards into the sustainability reporting standards, which will become effective on 1st January 2027. Furthermore, OJK will also adapt and align these standards into its regulatory framework. So it's needed to ensure a consistent application across Indonesia capital market. The purpose of today's webinar is to support listed companies, exchange member, and all Indonesia business in preparing for the effective implementation of IFRS S1 and IFRS S2. This will enhance the availability, quality, and comparability of sustainability information disclosed by companies in Indonesia in line with global standards. Indonesia Stock Exchange has consistently encouraged listed companies to integrate ESG into their strategies and disclosure. With the adoption of IFRS S1 and S2, we believe Indonesia will take an important step forward in strengthening investor confidence, improving transparency, and promoting sustainability investment practice. Ladies and gentlemen, we hope today's workshop will provide practical knowledge and useful guidance on IFRS sustainability standards, enabling all participants, especially listed company, to be better prepared for the upcoming requirements. May the discussion today inspire meaningful action and accelerate our journey toward building a more resilient, transparent, and sustainable capital market in Indonesia. Again, thank you very much. I give it back to Miss Fiona. Thank you.
Yes, thank you so much, Chiku, for that fantastic introduction to the session. And it's brilliant to hear all of the support that IDX are providing issuers to advance this topic. So many thanks again for being with us today. Fantastic. So I'm pleased to say we also have a second short opening remark from my colleague Kate Lazarus of the ISC. So Kate is the Senior ESG Advisory Lead for the Asia Pacific region, at the IFC, who are also working closely on these topics with organizations in the region. So many thanks as well, Kate, and the floor is yours.
Okay, good afternoon. Thanks, Fiona. It's my privilege to welcome you to this important session on the IFRS Sustainability Disclosure Standards as well. As mentioned, my name is Kate Lazarus, and I'm leading IFC's ESG Advisory Program in Asia Pacific. I'm based in Bangkok in Thailand, and we provide guidance on the private sector on ESG and sustainability and to market intermediaries such as stock exchanges, regulators, institutes, and associations. So on behalf of the IFC, we're part of the World Bank Group. I'd like to extend our appreciation to our distinguished host, Mr. Teku Ariandar from the Indonesia Stock Exchange, a longstanding partner of IFC. So we also appreciate that. Today's training is a result of the partnership, as mentioned, between IFC, UN Sustainable Stock Exchanges, and the IFRS Foundation, aiming at strengthening sustainable capital markets by enhancing sustainability and climate reporting in emerging markets and developing economies. Our joint efforts will ensure that emerging markets and developing economies are not left behind in the global shift towards sustainable finance. To this end, the training focuses on the IFRS sustainability disclosures S1, the general disclosures in S2, the climate-related disclosures. As mentioned, these were launched in June 2023 by the ISB and of the IFRS Foundation. And you'll learn a lot more about it, so I won't go into detail about that during the training. We'll cover in great detail. So over the past few years, there has been significant surge in demand for sound ESG data and disclosure, and the launch of the reporting standards is crucial because it's really brought together the long-anticipated conversion of sustainability disclosure frameworks. We at IFC are really pleased to partner with various regulators and stock exchanges across Asia Pacific, and wanted to highlight one partnership such as the Bangladesh Bank because they developed the guidelines on sustainability and climate-related financial disclosures and is the first central bank in South Asia and a trailblazer to adopt the ISB climate-related financial disclosures of IFRS 1 and 2. So also we've been working with the Financial Regulatory Commission, FRC, in Mongolia, the Sabon in NEPSE in Nepal, and in many other jurisdictions. So we're really happy to see Asia Pacific also paving the way and being able to provide regulatory trainings across the region to a wide number of stakeholders. But more specifically in Indonesia, there's a lot of work going on, as has been mentioned, and in this space, most notably on the 1st of July, 2025, the Institute for Indonesia Chartered Accountants, IAI, ratified right, the Indonesia general requirements and climate-related disclosures, so fully aligning with IFRS 1 and 2. And this will become effective when the reporting period begins on 1 January 2027. There was also extensive public consultation processes prior to the ratification until March to ensure stakeholder engagement and readiness. And IFC, through our partnership with the Indonesia ESG program supported by the Swiss government, SECO, is working with IDX and IAI to revise the IDX guidelines on ESG reporting for listed companies in Indonesia to be aligned with the adoption of IFRS S1 and S2. And this is still at early stage. And I'd like to give a shout out to two of my colleagues who are on the line as well from our Indonesia program sitting in Jakarta, Rahajeng Pratiwi and Dedi Palimia, who are there if you have any questions specifically about our work in Indonesia. And on the regulatory side, OJK, the Indonesia Central Bank, is currently aligning its sustainable finance regulation on sustainable finance to be aligned with the adoption. And this has really all led to heightened readiness among companies. So it's good to see so many companies on the line. As of December 2024, 94% of IDX listed companies already published sustainability reports under the current OJK regulation. And this provides a strong base for transitioning to the IFRS aligned standards. And more in terms of global alignment and market impact, I think Indonesia's move to IFRS-based sustainability standards positions its capital markets for greater transparency, comparability, and investor confidence, and aligns with global ESG disclosure trends and supports sustainable finance growth. So we offer congratulations on these key steps taken in Indonesia as well. Lastly, I'd like to just introduce IFC's Beyond the Balance Sheet platform. It's a valuable global resource. You can find the link in the chat and in the training materials. And this platform offers a step-by-step toolkit for preparing reports that align with IFRS and other global standards. And it's really a resource that's continuously being updated, providing a whole range of different tools. So we believe today's session will strengthen your understanding of these standards, support your work in advancing sustainable finance. And we at IFC are committed to collaborate, supporting companies and regulators in Indonesia and elsewhere. And we see this as a great opportunity. So thank you and enjoy your learning today. Back to you, Fiona. Thanks.
Many thanks, Kate, and fantastic to know of all the support being offered to companies in the region through IFC. So fantastic to hear and great to have your colleagues with us as well. Do feel free to say hi in the chat as well if you'd like to let everyone know who you are. Brilliant. So thank you so much, everyone, for that great start to the session. So with that, I'll just be covering a few housekeeping points and a bit about the agenda for the training before we get into the content itself. So firstly, you've probably noticed by now that as attendees, you are muted in the session, but that really doesn't mean that we don't want you to take part. So we'd encourage you to keep using the chat function to engage with us and share your general comments as you're already doing so. That's fantastic to see. And if you have particular questions for the team, please make sure to use the Q&A box to ask us your questions, which you should have available at the bottom of the Zoom toolbar as well. And that's just a great way for us to make sure that we keep track of and directly answer your questions as well. So in terms of our format for the training, we have a half-day, 3.5-hour live session here together. And we also have an optional follow-on activity that you can take away as homework if you'd like to, which we'll explain a little bit more later in the training. As I've already mentioned, we've got live question and answer possibilities throughout. So please make sure to use that opportunity to get your questions answered. As I'm going to cover in a second, we've got a number of fantastic experts with us here today from the SSE team and from the IFRS Foundation who are ready to help you with those questions. So make sure to use that Q&A opportunity that we have here together. And we'd very much encourage, as I say, your participation in the session as well. So we'll be using a number of interactive tools such as Menti and polls. So please do take part in those as well. It's always really great to hear your perspectives on these topics and what your organisations are doing on these as well. And then finally, if you take part in our full training session live today, you'll also be able to receive a completion certificate. To get your certificate, you need to complete a survey, and we'll share the details about how to do that with you at the end of the training session. So just to mention, who'll be delivering the training for you today. So firstly, you're probably already familiar with myself, Fiona, from the SSE team, and I'm joined by my colleague, our senior specialist, Lois Guthrie, as well. Hi, Lois. And alongside us, we're pleased to be partnering with our colleagues in the IFRS capacity building team. So firstly, we have Robert. He is a partnerships manager in the capacity building team. Hi to Robert. And he's joined by his colleague, Bella Cheng, who is a capacity building specialist as well. So a great team to support you in understanding the technical detail of these standards. So for our training session today, we have 3 key learning objectives that we're hoping to help you achieve. So firstly, we'd like to help you to understand the ISSB standards. Secondly, to understand how you can use and to put into practice those standards. And then finally, to identify the steps that you can take to develop a disclosure plan to apply the ISSB standards. And we'll talk a little bit more around what a disclosure plan is during the training session. Keep in mind, those are the 3 key areas we want to try and help move forward with our session today. So to break that down into an agenda that helps us to digest these things in different chunks, we've developed a structure that we're going to be working through in our training today with 4 key modules, as you see there. We share this just so that you can get a sense of where we're at in the training session as we're moving through the content. So we'll start with prepare. That just gives us our understanding of what the purpose of sustainability reporting is and understanding how the reporting landscape has evolved to reach the global baseline that we have from the ISSB standards today. And then we move into Align, our next module, which is all around setting the direction for your reporting. So thinking about how you're going to apply and use the standards and what additional disclosures you may need to add to meet particular requirements in your geography or sector or to meet different regulations as well. Following that, we'll come into Implement, which is all around putting in the practices and systems that you're going to need to identify, evaluate, and integrate sustainability risks and opportunities in your organizations. And then finally, we'll finish with Communicate. So this is all around preparing the final format for your reporting. So thinking about the location and timing of disclosures and how to do so efficiently and in a way that generates user confidence in your reporting as well. And so just to show how that module structure breaks down across the training session, we'll be spreading our modules out across the training. We have quite a lot of time on module 2 in Align because there's lots to cover on how to directly align with the standards, but we'll be taking a short break as well in the middle, and we'll finish off at the end of the session with some homework and additional resources to share with you as well. So I think I've seen this question has come up already, but just to note that you'll be able to find all of the materials from today's training session on the event webpage for this session, which my colleague Lois will share the link to in the chat with you shortly. And so on this page, if you go to resources at the bottom, you'll be able to find the slide handout from the training session today, as well as the homework assignment as well. And if you follow the slide handout link, that's where you'll be able to then find as well all of the links to the different resources and guidance that we'll share with you in the session. So thanks, Lois. She's just shared that link with you again now. We'll also add the recording of today's session to that page in the next few days later in the week after the session as well. So as I've mentioned, we have a homework assignment, which I'll just mention now at a high level and we'll come back to later. So you can download that homework assignment from the resources section of the webpage that Lois has just shared the link to with you in the chat. So as I've mentioned, this exercise isn't mandatory and it's not something you have to submit to us. However, we've developed the homework to help you develop that draft disclosure plan for your company, to put in practice what you've learning in the training today, and hopefully help you to take these issues forward in your organization as well. So please do check that link out as well to help continue your learning and development of your capacity and disclosure practices within your own organizations too. And I'll also just mention quickly the SSE toolkit that we have, which provides a number of different resources to support you on the implementation of sustainability reporting and in particular the ISSB standards. So I'd encourage you to check out the link available in the handout material there. You have the QR code and also the link that Lois has shared in the chat to that as well. Okay, so to get us started, we've now got a quick interactive exercise in Menti to get us all used to using that tool and also to hear a little bit about why you're here with us in the training today. So to access Menti, my colleague Lois is going to share with you in the chat a link to get you directly into the exercise that we'll do together. But I'll also share my screen now and I can share with you two more ways that you might choose to use to join us if you'd like to do so as well. But probably the easiest thing will be to use that link that Lois has just sent to you in the chat there. Your other options to get into Menti will be to scan that QR code you have in the bottom of my screen now. And also, as well, at the top in that black coloured box, you can see if you go to menti.com, you can also enter that 8-digit number code you're seeing at the top of the screen. But probably the simplest option is to use that link that Lois has already shared with you in the chat, and that'll take you directly there. So our first question in Menti is just to get a sense in your own words as participants why you're joining us in the training today. So feel free to share with us just a quick couple of words to let us know what you're here to learn about. And that'll be interesting just to get a sense of everyone's focus for being here today. Okay, fantastic. I'm seeing lots of, I pushed by regulator. I like that. I'm seeing knowledge, learning, growth, alignment, upskilling, sustainability reporting, deepening knowledge. Oh, it's moving so fast, it's hard to see. Curiosity, growth, compliance. Interesting. Okay, I hope so. Yeah. And lots of ideas and concepts, I think, that hopefully we're going to be able to help you get into today. So fantastic and great to see lots of you have found the way into Menti successfully, which is always the first thing we want to test at this stage as well. So brilliant. Thanks, everyone. Great. So hopefully all areas that we can help you move forward on today. And then our second warm-up question is just to get a sense from you about how much you already know about those 3 learning areas we're hoping to help cover today with you. So you can use that sliding scale that you'll be seeing now to let us know from left, maybe being brand new to these topics or not very comfortable, to the right-hand side being maybe you're quite familiar already, you've implemented these things, or you're working with organizations on this topic already. Letting us know basically, your comfort on explaining to your colleagues and team what the ISSB is, on using the ISSB standards themselves, and on developing a sustainability reporting strategy. Great, so thanks for those who voted already. I'm seeing overall probably people are somewhere on the lower to middle end of comfort at the moment, perhaps most confident on the overall sustainability reporting strategy, but want to learn more about using and communicating the ISSB standards, which of course is our primary focus for the training today, so you're in the right place to learn about those things. Okay, great. Thanks everyone for sharing that. So I'll take us back now to the slide presentation and we'll kick off with a little bit of our first module. So I should say as well, we'll come back to Menti again later in the session. So it's worth maybe keeping that tab open in the background and that link will be there for you when we come back to do some more exercises together. Firstly, just to get us started on our first content area. So I have a quick disclaimer that I need to share with you first. And this is really just to be clear with you about how we're going to be using company disclosure examples in the training session today. We know that it can be helpful to see real examples to put into practice what we're talking about, but we'd just like to be clear that we're not endorsing these examples as the best or the right way to approach a particular aspect of disclosure. And these are really just shared to give you a bit of a flavour of what you could do. But of course, you need to do what's best for your company in your unique circumstances with this as well. Okay, so with that established, we'll be moving now into our first module, Prepare, which is all around building that solid foundation of knowledge and maybe thinking about what you might already know about sustainability reporting standards and frameworks. So our starting point in Prepare is to think about purpose. And so this is really to think about the case for sustainability reporting, what the market and business drivers are. We'll then move into landscape and think about how we've evolved to the current situation and how the reporting landscape is simplifying. And then in the global baseline section, we'll cover off the core concepts and requirements of the S1 and S2 standard. But getting started in purpose, we'd like to think here about why and looking in particular about what our drivers are for focusing more on sustainability reporting. So to get us started with that, we've got a quick poll question to get a sense from everyone here of what your primary drivers are for focusing on this topic. So the poll question should be visible for you now, and you've got the option to let us know which of these factors you think are most important for you in bringing you maybe into the session today, or for focusing you or your organization on sustainability reporting. So there's a couple of options here. You can select more than one if more than one of these applies for you. And also, if we've missed any reasons that are important for you, feel free to share those with us in the chat as well. Great. I see lots of you taking part in the polls, which is great, fantastic. We'll be using these a number of times in the sessions, and it's always good to get a really good participation rate so we get a good, realistic sample size of what you're all saying. So great to take part in these. So thanks, everyone. Okay, so I'll close that poll now, just in the interest of time, but don't worry if you didn't get the chance to take part. We'll have plenty more opportunities to do that. But it looks like very much so the top factor for many of you is that regulatory requirements driver. So unsurprising, I think this is the case in many markets, but indeed that regulatory pressure looks to be the top driver for a lot of you. And then maybe the second option, perhaps a little bit lower, but still of interest for around half of participants, is that investor interest as well. So thanks everyone for sharing, always really interesting. And we'll go a little bit more now into some of these drivers as well, and aim to also highlight what some of the benefits could be for you internally as an organization in managing these issues too. So firstly, starting with that investor perspective that I know a number of you highlighted there is a key factor for you. So we've seen a real growth in recent years in the investor interests in this topic, and this is shown in one part by this data that we have here from the Principles for Responsible Investment as to the number of investors globally that are signed up to their signatories, a signatory to their principles. And so what we've really seen is that there's been a big uptick since perhaps around 5 years ago in the number of investors that are focused on sustainability and ESG, or environment, social and governance factors. And so what is it that's really driving this interest? I think what we'd really like to highlight here is that a key driver behind that interest is really the expected financial effects of these factors. So here we have a study from Morgan Stanley of retail investors, which was looking at what their reasons for interest in sustainable investment were. And at least among the sample of individual investors here, we saw that financial performance of sustainability investments was actually their top reason for focusing on this. So important to say that it's not, a nice to have anymore, or something that's just focused on impact alone, but also something sustainability is very inherent and important to our understanding of financial performance more broadly. And so I've talked about financial performance there, and it's important to cover off a few key terms about this to get us started. So it's important to remember today that we're talking about disclosing financially material sustainability information. So we'll talk later about what we mean around materiality, but we want to be clear at the start about the sorts of financial effects that investors are looking to have more information on here. So firstly, we have effects on financial performance, which we typically see reflected in an organization's revenue statement or profit and loss statement. And so we can see that sustainability-related risks and opportunities can have financial effects, for example, by changing potential revenue mix or total revenue of an organization, or possibly changing its expenditures as well. If, for example, there's a change in operating costs to manage a new regulatory requirement, or if there's a need for research and development to capitalize on opportunities as well. And the second key aspect we have here is effect on financial position. So this is relating to the balance sheet of a company or its statement of financial position. And so here we can see financial effects as well. We could see changes to assets or liability values as a result of climate or sustainability issues. And we could also see changes to financing and the cost of capital as well, which can be both positive and negative. So, for example, we might see increased insurance premiums as a result of sustainability risks or climate weather events, but we could also see opportunities in terms of capital availability through new financing structures such as green bonds or social bonds. And another really key concept to introduce to you all at the start of the session, if you're not already familiar with it, is the evolving nature of sustainability risks as well. So you might have seen this visual before, which comes from the World Economic Forum's Global Risks Report. And what we want to really highlight here is that the sustainability risks that are front of mind now, or the business risks, might be quite different 10 years from now. And actually, we see that a lot of environmental and social and governance factors may become much more material over a longer term horizon. But actually, if we need to take action now to manage those risks or realize opportunities, it could be that the financial effects that I was just talking about now could be felt a lot earlier than the risk itself would materialize. So it's important to remember that those time horizons can vary somewhat when we're talking about sustainability risks. And a second key thing to highlight here is the connection between risk types as well. So whilst we might talk about different sustainability topics as different disclosure standards, of course, the interconnection is really strong across different environmental, social, and governance topics. So as much as we can when we're thinking about our internal strategies and our external disclosures, we need to try to think about the connection between these risks. So something to come back to when you're starting to prepare your disclosures as well is that real interconnection across topics. Okay, so that was the purpose section of the content. So just a little bit of an intro to why we're here and some of the key drivers behind this. And I'm now going to hand over to Lois, who'll get us started on a bit of an overview of the reporting landscape. Thanks, Lois.
Thank you, Fiona, and hello, everybody. So we're going to look in this section about how sustainability-related financial disclosure standards evolved. But before we do so, can we ask you via Zoom what frameworks you are currently using for your sustainability disclosure? You can answer as many as apply. Are you responding to the CDP survey? Are you using the Global Reporting Initiative standards or the Integrated Reporting Framework? Do you use the Sustainability Accounting Standards Board standards or the recommendations of the Task Force on Climate-Related Financial Disclosure, United Nations Global Compact principles, or something else? And if you do use other standards or frameworks, do let us know in the chat. Great to see so many of you participating. Sorry, we have to get through these polls quite quickly sometimes in the interest of time. So I'm going to end the poll, share the results with you, and you can see quite clearly that the majority of participants today are using the Global Reporting Initiative standards, followed by a mix of integrated reporting others, and some responding or using some of the other frameworks that we've mentioned. So that's very helpful context. Thank you very much for letting us know. So we're going to move on now to have a look at this slide, which tells us about the structure of the IFRS Foundation, the organization that developed the standards we're going to be talking about today. The IFRS Foundation is a not-for-profit public interest organization that was established to develop high-quality, understandable, enforceable, and globally accepted accounting sustainability disclosure standards. At the bottom of the screen, you can see that there are two independent standard setting boards inside the foundation. The International Accounting Standards Board, or IASB, formed in 2001, develops financial reporting standards which are in place in over 140 jurisdictions around the world. The International Sustainability Standards Board was formed in 2021 following strong market demand for its establishment. It released its first two standards that we'll be talking about today in 2023. Governance of the standard setting boards is provided by trustees, and they are in turn accountable to the monitoring board of public authorities. And because the two standard setters work within the same foundation, they're able to ensure that their standards complement each other. how did all this happen? Well, the IFRS Foundation didn't start from scratch when developing the ISSB standards. All of the organizations whose logos you see on the screen and many more contributed to the development of sustainability reporting as we see it in the ISSB standards. Now, this may look confusing with lots of different logos on the screen and lots of arrows, but actually the message to take from this slide is this is a picture of harmonization and standardization. As you'll see at the bottom of the screen, the Climate Disclosure Standards Board, the Integrated Reporting Framework, and SASB's work was consolidated into the IFRS Foundation sustainability work at the outset. The TCFD, the Task Force on Climate-Related Financial Standards Disclosures, its work has now ceased as TCFD, but it's been adopted into the ISSB standards, and adoption of climate reporting is now monitored by the ISSB. Similarly, the work of the Transition Plan Task Force, insofar as it relates to disclosure, is now the responsibility of the ISSB, and CDP has aligned its climate questionnaire with the ISSB's IFRS S2 climate standard. And GRI, they're also committed to working jointly with the Foundation to identify and align common disclosures. So harmonization and simplification. But what does this mean, for example, for those of you that have been using the recommendations of the TCFD? Have a look at this poll and let us know what you think. Companies who disclose using the TCFD recommendations automatically comply with the ISSB standards. Is this true or false? Give you a minute to think about that. Yes, we're getting a good level of participation. It's so nice for us as presenters to see you participating. But in the interest of time, I'm going to end the poll and share the results. And you can see our participants, you're quite evenly divided here. Nearly half of you saying true, half of you saying false. I can understand exactly why this has happened, because we've just told you in the slide before that the TCFD has ceased its work has been taken over for the ISSB, so I can understand why you might think true. But the right answer is false. It is false. If you already use the TCFD recommendations, you cannot assume that you automatically comply with the ISSB standards. And we're going to look at the reason why just now. The reason is that the TCFD recommendations have been adopted into the ISSB standards, so you will be very familiar with what you see in IFRS S2, but there are some differences, and that's why the answer was false. There are three types of differences. First of all, different wording is used to capture the same information. Secondly, S2 requires more detailed information than we saw in the TCFD recommendations. So, for example, might ask for more details about how carbon credits have been used to satisfy climate targets. And thirdly, S2 asks for some additional requirements and provides additional guidance. And an example here is S2 provides sector-specific guidance for companies. If you want full details of the comparison, it's in the little document that you see thumbnailed on the left. So that although it's very, very similar, there are some differences. That's the message to take away there. So the ISSB's main objective was to set a global baseline for sustainability information. And this global baseline that is the ISSB standards provides a comparable and consistent basis for sustainability disclosure across the world, a common language for comparable disclosures designed to meet investor needs across global markets. But the ISSB recognises, of course, that additional disclosures might be needed because they're to satisfy jurisdiction-specific requirements or the needs of broader multi-stakeholders information requirements, and therefore building blocks of information requests can be added to the ISSB's baseline. So this could take the form, for example, of asking the sorts of information that GRI requests for on impacts, for example, or very jurisdiction-specific information relevant to investors. And having this approach with the baseline and the building block approach means that you can still have this globally consistent baseline of disclosures whilst allowing jurisdictions and others to add information requirements based on standards like the GRI standards. There's been global backing for this approach that's reflected in the ISSB standards. The International Organization of Securities Commissions has announced its endorsement of ISSB standards and asked their 130 members around the world to consider how they can incorporate ISSB standards into their regulatory frameworks. Audit standards have been developed, assurance standards that is, and you've probably seen the International Sustainability Standard on Sustainability Assurance 5000 that's going to be effective from December 2026. That was issued by the International Audit and Assurance Standards Boards to support sustainability disclosure. The ISSB is, of course, working with jurisdictions around the world through its regulatory implementation program to support jurisdictions in their planning and preparation for voluntary and mandatory adoption of the standards. And of course, there's work, capacity building work like this webinar today to support jurisdictions who are contemplating voluntary disclosure against the new standards. And with that, we're going to hand over to our colleague Robert, who's going to start taking us through the standards.
Yes, sorry, apologies. Thank you very much, Lois, for this introduction. Indeed, then we'll move to the next section of this module. And hello, everyone. My name is Robert Svetoski. I'm the partnership manager from the IFRS Foundation. Yes. As Lois mentioned, we covered now the business and market case for sustainability reporting and how the landscape is becoming more streamlined. And so now let's turn our focus on the IFRS sustainability disclosure standards, namely IFRS S1 and S2. But before we go into the standards themselves, let's clarify a few key terms we will use throughout. So you will hear us today saying quite often sustainability-related financial information. That simply means information about company sustainability-related risks and opportunities that's useful to investors. So things like climate, biodiversity, or social issues, if they could affect companies' financial outlook. So we'll also mention general purpose financial reports, and that includes the financial statements, but also the management commentary, sometimes called a management report or strategic report, depending on your jurisdiction. Right, and in here, that's an important slide to show four core content areas, and then around which the standards have been built. And again, if you're familiar with this EFD, we should also be familiar with this breakdown and categorization. The ISB standards are structured around the same four core pillars, and these are governance, strategy, risk management, and metrics and targets. We will go each through these areas more into detail and the requirements behind those areas later. But if you haven't read the standards, then I recommend downloading them and reviewing the detailed guidance. All right, so with this introduction, let's move to the standards themselves. Let's start with the IFRS S1. And so to mention here, I think it's important to say, don't worry. So it might sound technical at times, but much of this builds on the concept you already know. So IFRS S1 sets out the general requirements for disclosing sustainability-related risks and opportunities, regardless of topic. So not just climate, but also social or biodiversity risk if they are financial relevant. What is also important, and I also mentioned already, that it builds on the TCFD framework and points preparers to SASB standards and other guidance to help identify relevant issues and metrics, especially at the industry level. So that makes the disclosures more tailored and meaningful. And importantly, IFRS S1 is designed to work alongside existing financial reporting standards, regardless of your national GAAP standards in place. So that's a very short introduction to IFRS S1. Let's then quickly present you the second one, the IFRS S2, which is specifically focused on climate. It builds on S1, but zooms in on climate-related risks and opportunities, like physical risk, like floods, droughts, and transition risk, like policy changes, low carbon technologies, and so on. It also incorporates all the TCFD recommendations, but goes further. For example, it includes requirements on greenhouse gas emissions, scenario analysis, and industry-specific climate metrics. Again, SASB industry-based guidance is essential here. It helps identify which metrics are most relevant to your company activities. Preparers must also refer and consider the applicability of the industry-based guidance on implementing IFRS S2. As we already said, this is organized by industry, enabling company to identify climate-related disclosure topics and metrics applicable to its business model and operations. All right, so you now have a good understanding, at least, on what the S1 and S2 are about, and then let's see how they work together and how they relate with each other. So S1 and S2 aren't optional add-ons, they are designed to be used together. So even if you're reporting on climate this year, you'll still need to apply IFRS S1 because it sets the framework, defining materiality, requiring connected information, and outlining how to present disclosures that are useful for investor decisions. It also provides, S1 also provides important guidance on the assessment of materiality. All right, and with the next slide, I want to touch on some underlying concepts that guide how information should be disclosed. So the standards require a fair presentation. That means providing a complete and neutral and accurate picture of sustainability-related risks and opportunities. And the other concept, which is important here, it's reporting entity. So that concept requires the organizational boundary for sustainability-related financial disclosures and financial statements to be the same. Another important concept is connected information. We saw earlier when Fiona explained how different risks are often interconnected. So that's one concept of the connected information, and the ISB standards require companies to clearly identify key connections between risks and opportunities, connection also between the 4 content areas we discussed briefly, and also connections between sustainability-related financial disclosures and the main financial statements. All right, and exactly on this point, we have now an example, and Lois will present this to you.
Thank you, Robert. So as this is our first company example today, I just want to remind everyone of the disclaimer that Fiona gave us earlier, that we present our examples to you to inspire and to illustrate certain points that we're making during the presentation, but the examples we give shouldn't be regarded as good or best practice. They're just for inspiration. So our first example is from BHP's annual report 2024, and BHP is a global mining company. And the example is to illustrate the point that Robert just made about the fact that information should be connected. So what sort of connections do we see in this particular example? The company's telling us about the impact of climate-related risks on their business strategy and capital alignment and allocation. So in the first paragraph, they tell us that climate risk assessments and climate scenario analysis are integrated into the company's strategy, its overall business strategy, and treated as a sensitivity in their capital allocation process. So we can see that climate is not being regarded as a separate issue, but the implications of the climate risks are being connected with business strategy and capital allocation decisions. Secondly, in the second paragraph, they tell us that some of their assessments are still in progress. They're undertaking studies to assess the future physical impact of climate risk on the company's operations, productivities, and costs. But they tell us as soon as they've got the results, they will be used to inform the company's risk profile, its overall corporate planning, its controls and adaptation measures. So again, they're connecting physical risk to their business planning. In the light grey text, we see connections to where we can find further information on the impacts of climate-related risks on operational activities, greenhouse gas emissions across the value chain, on their financial statements, including on production revenue and expenditure. So just one little example showing lots of connections about decisions, plans, and different information types. So well, let's hand back to Robert now for another Zoom poll.
Yes, great. Thank you, Lois. Yes, indeed. Let's then have a first. Oh no, that's gonna be I think no, it's already a fourth one, a Zoom poll. And so just to pause here, and the Zoom poll should appear on your screen. This Zoom poll is about connected information, a key concept in IFRS 1, which we discussed. So this is just to check your understanding. So the question is, what types of connections are important to consider? And then please select all the options which apply here. So we have three options: connection between governance, strategy, risk management, metrics, and targets. So for core areas, and then between the risks and opportunities, and between financial disclosures and sustainability-related financial disclosures. Great, I see many of you participating. I'm gonna end the poll right now. Most of you answered this correctly. So by connected information, we mean having a connection between all these three different areas, or the three different categories of areas. So connection between the four core pillars, and then between the metrics, between the risks and opportunities, and also between the financial statements and sustainability-related financial disclosures. This is meant by connected information. So if you choose all A, B, and C, then you are correct in this case. All right, let's then move to the next topic, an important one, and it's about materiality. So the standards are built on a concept of materiality as defined by the IFRS foundations. We will go through it in more detail later, but for the moment, just to highlight that we will be referring today to material information, which is information that, if omitted, misstated, or obscured, could reasonably be expected to affect investor decision making. So this is the materiality definition, which is and fundamentally in principle the same as this is in the accounting standards as well. All right, and for now, let's then move to some additional guidance which should help you in your journey in the sustainability, in preparation of the sustainability related disclosures. So during the ISB consultation on the exposure drafts, and one of the key feedback topics was the importance of supporting preparers, particularly those with limited resources and those in emerging markets. So in addition to standards and application guidelines published in 2023, a number of educational resources were also published, and since then others have followed, including the IFRS Knowledge Hub. We are also in the process of gathering examples and case studies provided by our partners. Further, the SASB standards were aligned with the IFRS 2 to help preparers seeking industry-based guidance, and the FSA credential also was updated with more planned to come. And here I should also note that IFRS Foundation Capacity Building Program launched at COP27 is a key part of support to preparers, and this SSE training initiative is one of the most important deliverables. All right, and with that, we're going to have another Zoom poll, already number 5. This one might be a bit more tricky, so let's see how you answer this one. So imagine this. The water is a vital input to your business, but the ISB standards don't have currently a specific standard on water. So what would you do to this in this situation? So please do take a moment, read the options, and choose the one that seems most appropriate. So the options are: do not disclose anything about water because there's no standard for that. Consult sources of guidance listed by ISSB. Answer C, engage a consultancy to help, and D, copy your competitors' reporting. So what should be the right action in this case? And I see there most of you are choosing one of the answers, and I'm gonna end the poll right now. And yes, indeed, most of you answered correctly that the right action should be to consult the sources of guidance listed by ISSB. So that's what should be your priority here. Of course, engaging consultancy, it might be an option, and that's totally fine to seek for the consultancy to help you on the topic. But the thing you should definitely do, it's consulting the additional guidance listed by ISSB for the topic of water. Of course, competitors reporting or not disclosing anything about water are not the right choices here. All right, so with that, I'm going to hand over to Fiona. She will then provide a summary of module 1. So over to you, Fiona.
Great. Thank you so much for that, Robert, and to Lois as well. So as you say, that brings us to the wrap up now on our first module. So we're going to take a minute to just review some of the key concepts we've covered so far before we do a quick Menti exercise to close out that module. So firstly, we reviewed the purpose of sustainability disclosures. And a key takeaway we're hoping that you leave this workshop with is that there are important benefits, both internally and externally, for collecting and disclosing sustainability-related financial information. So ultimately, if you're not aiming to make good use of that data that you're collecting to improve your strategic decision-making, you're going about this wrong and you're missing a bit of an opportunity. Especially if you have operations in hard-to-abate or high-impact sectors, your competitors could already be disclosing the risks that they face there and identifying opportunities that they're pursuing to transition their business models. And that's going to start to leave your investors wondering why you're lagging behind and not managing those risks and opportunities. So that could start to affect your ability to raise funds as well. We then looked at the evolution of disclosure standards and the formation of the ISSB with the aim to simplify the reporting landscape. So when you're thinking about voluntary disclosures, you shouldn't see those as competing with the ISSB standards, but rather building on top of them. And finally, we introduced the standards and the important concepts that you need to understand in order to use them correctly. And a key point that I want to reiterate here from what Robert already covered is that these standards and the guidance that come with them are designed to meet the needs of investors. And so they're heavily focused on those prospects relating to effects on financial performance and position that we discussed at the very start of this unit. Okay, so with that, we'll now go into our first exercise. And so we have 4 exercises today, and they're kind of aligned to the concepts that we look to cover in developing a disclosure plan. So they'll connect into that homework exercise that you could choose to take away as well, in helping you to set out the core components of what that disclosure plan could look like. And so the first aspect that we kind of recommend to start with for the disclosure plan is clearly defining the objectives of your sustainability disclosures. So it's important to have a clear goal on what you're trying to achieve with your disclosures, and maybe how you plan to adapt what you're already reporting to meet the new requirements. You also want to think a little bit about particularly what requirements you're looking to meet. So maybe that's aligning to S1 and S2. Maybe it's to meet the particular requirements of jurisdictional regulations, listing requirements, etc., or certain guidance. And overall in this, you need to think a little bit about what the degree of change is that you need to make from where you are now. So maybe it's a big change because your organization isn't really doing reporting at the moment, so you've got to put in place quite a lot. Or maybe it's just smaller tweaks and additions if you already have some more advanced reporting that you just need to adapt. So important to be clear, I think, with your colleagues internally on what that change looks like and what the goals of it are. So that's our first question to reflect together on in Menti is, what are your objectives that you're aiming to achieve through sustainability disclosures? So you don't have to have your fully formed answer, but just share with us your immediate reflections, maybe if this is something you've already thought about, or maybe it's something that you've been thinking about as we've been talking during the session about the different drivers and stakeholders that might be important. And let us know what your reflection is on your aim for sustainability reporting. We should say, of course, we know many of you here are involved directly in preparing reporting. So, of course, it's easy to answer these questions from that perspective. If your role is a little bit different here, maybe you're an advisor to others, maybe you're a regulator, feel free to share whatever comes to mind from your own perspective as well, and that's absolutely fine. Great, so seeing lots of responses in already, which is fantastic. Thanks again for all of that participation. So let's have a little look at what the responses are thus far. So I see someone's mentioned compliance with regulations. I know I heard early in the session from many of you that that was a key piece that's front of mind. So maybe it's good just to be clear in your objectives from the start about compliance. Of course, we would really recommend that you try to think beyond compliance as well, because as we've already talked about, there are lots of reasons internally why there are benefits to managing and disclosing these issues as well, and with other aspects of external performance too. So good to have compliance as a priority, but of course, trying to think beyond that is something we'd recommend too. So similarly, I see a few people mention regulatory standards, understanding the minimum of what needs to be disclosed. Someone's mentioned around standardizing reporting in accordance with investor standards. So exactly, and maybe, as you say, attracting investors as a result of that. So if you're aligning to these requirements and giving investors that information they need to understand your business and how you're performing and your kind of future direction, long-term resilience, that's likely to be positive in terms of how investors view and understand your company. Okay, so and then I've seen a few answers here that kind of balance a few factors, which I think is something we'd encourage you to think about indeed. So thinking not just about fulfilling the regulatory requirements, but also about how that enhances your transparency with stakeholders, builds trust, and an understanding of your business indeed. So these are all good ideas. Thanks, everyone. I think I see a few common themes among these ones here around, strengthening that stakeholder understanding of your business and demonstrating your organization's commitment to responsible practices. Great. And someone's mentioned here around managing risks and showcasing your progress as well. So yeah, maybe it's one thing to set yourself sustainability targets, but it's important to be transparent about how you're progressing against those. Someone's mentioned also about maybe driving operational efficiency as well and innovation, which indeed was a great way to think about this internally. And they've mentioned as well, supporting strategic decision making. Exactly. So trying to close that loop and think about not just what you're putting out there in the public domain, but how you can use that information for your organization's own management as well. Great. I see some common themes here around investors and risk as well coming up a few times here, which is, again, a good point to highlight. So indeed, how can you strengthen your risk processes with this insight, I think is a good factor to reflect on. Great. Thanks, everyone. I'll just have a little flick through. I see lots of common themes. And someone's mentioned here differentiating the company from its peers as well. So yeah, indeed, that could be a good point to highlight. So, if you're getting ahead of the game in identifying these risks, taking action, capitalizing on the opportunity, indeed, competitively, that could be a good thing and likely will mean your assessment by your investors of you compared to your peers could potentially be more favorable as well. Lovely. Okay, loads of great ideas here, everyone. Thank you. I'll leave that window open in the background for you for a while so you can also have a look at what other people have responded there. But yeah, I think fantastic kind of reflections here so far. And I think as many of you have already done, what we'd really encourage you to do here is to think clearly about the audience of your disclosures. So many of you, of course, have mentioned investors, and indeed that's what the S1 and S2 standards are designed to serve. So making sure you're clear on that audience, thinking about any feedback you've had from your investors as well is important. And as again, a lot of you have highlighted, balancing that need to comply with reporting requirements or regulations with also aiming to maximize internal benefits from the outset here is something we'd really encourage too. Okay, brilliant. So I can see Robert's there and ready. So I'll pass back over to you, Robert, to get us started on our next module.
Great, lovely. Thank you very much, Fiona. Right, yes, we're moving to the next module of this webinar. So we'll now move to the module called Align. So now that we introduced the initial concepts, we're now focused on how to apply the ISB standards, taking into account additional disclosures, including any relevant geographical or sectoral requirements, as well as peer practices and new leadership objectives. So in order to understand how to ensure the disclosures meet global standards, we will look at the two concepts in this unit. So the first and the main focus on this unit will be on how to apply the standards to achieve global baseline for disclosure. Once we cover that, we will also discuss how additional disclosures fit. So to begin, let's focus first on how to apply the SB standards as a global baseline. And now we're coming back to this slide with the four core content areas, and we'll start with governance. And so the governance area includes aspects that relate to the governance body in your company and how management is applied. So let's now quickly go through it and what the governance is. So for each content areas, we will discuss questions that you could ask in your company to start identifying the information that would support some of this disclosure requirements. For example, as part of the gap analysis. So now, if we look at the governance and management requirements, we can see that there are several that are fairly qualitative. So, for example, to start with, the question relevant here to ask would be, which bodies are responsible for the oversight and management of the processes, controls, and procedures of sustainability-related risks and opportunities? For example, is management responsibility delegated to a specific role or committee? How and when do they get informed about sustainability-related risks and opportunities? So the shape and the form of the information will be relevant to disclose here. Also, how these issues inform strategy, decision making, and risk management. So this could include setting targets to manage sustainability-related risks and opportunities. And then finally, whether the progress against these targets links to executive remuneration should be also part of this content area and this disclosures related to governance. So for more information, you can make use of the SSE checklist tool, but please remember it's not a replacement for reading and using the full ISB standards. So with that, we will then look at a couple of examples of this to see what this means in practice. And again, Lois will provide you with this examples. So handing over to you, Lois.
Thank you, Robert. Thank you. So yes, we've got two examples of the way in which companies describe their governance models. And of course, there's no real prescribed method. This is for a company to decide, although they have to provide information as listed by Robert. So this first example is from Yara, which is a huge global crop nutrition company operating in over 60 countries. And as you can see, Yara has a highly integrated model with responsibilities for sustainability embedded across lots of different business functions, as we see in the pale green boxes in the middle of the slide. We can see that the Sustainability Governance Committee reports direct to the chief financial officer, who is also responsible for sustainability performance and reporting, and the CFO in turn reports up to the board level. So we can see that from the arrows. The arrows also tell us that the Sustainability Governance Committee is supported by a sustainability network, and all of these bodies are supported by input from different departments, including HR, ethics and compliance, global climate and energy, corporate affairs, and so on. The arrows also tell us how information flows between each of these bodies and committees, what are the reporting lines, and where there are available competencies to support the development of sustainability disclosure. So a complex but very integrated picture from Yara. As we turn to the next example, this is from Toyota, which is a car manufacturer, I'm sure you know. It's an extract from their 2024 report, and it explains the role of their sustainability committee within the company's wider governance structure. So the sustainability committee is one of the board, the business execution committees that reports direct to the president and board of directors. So here we see the frequency with which the Sustainability Committee meets. We see who chairs the committee, and in this case, the chairperson and responsible office is the Enterprise Risk and Compliance Management Department. So different to the Yara example we just looked at, where responsibility lay with the Chief Financial Officer. And we can also see the members of the committee, and again, from quite a diverse range of departments and experts within the organization, including HR, accounting, environment, technical executives, and so on. And finally, we can see what the committee actually does. Their main agenda is to approve actions on sustainability, approve targets, evaluate activity results, determine the direction of the company's approach on sustainability, that also takes account of engagement with stakeholders and observation of social trends. So with that, we're going to hand back to Fiona to take us through the next core content area.
Brilliant. Thank you for that, Lois. So hopefully those examples have helped to clarify there what the governance content area could look like. So that will move us in now to strategy. So there are more disclosures to include in strategy than governance, but it's also really where companies can start to see the benefits from better being prepared for sustainability risks and capitalizing on opportunities as well. So as you can see here, there are three high-level areas to focus on in the strategy content area, and these are risks and opportunities, effects, and resilience. So we'll review each of these separately now. So IFRS S1 and S2 disclosure requirements on strategy are designed to enable users of financial reports to understand the company's overall strategy for managing sustainability-related risks and opportunities. So what are those risks and opportunities? When will they affect the organization? And what actions are they taking to manage that? So if we first look at the requirements relating to sustainability, risks and opportunities, here we have some of the questions that organizations could want to start by asking themselves internally. So firstly, we're asked to think about describing what the effects of the risks and opportunities would be on the organization. And so thinking about what time horizons those effects could be expected over. And this is where we also need to keep in mind, as I talked about at the start of the session, that financial effects could occur before the risk or opportunity materializes, maybe afterwards, and they can change over time as well. And the last question on this list in particular is focused on climate risks. And so here investors are looking to understand the types of risks and opportunities that organizations have identified relating to climate change. And here companies typically will use the categories that have been developed by the TCFD on physical and transition risk, which we'll cover in a little bit more detail later. And alongside the standards themselves, there's guidance on both S1 and S2 to support companies. Oh, excuse me, we just flicked a few slides ahead. Just ask the presenters to be a little bit careful there. So, oh, yeah, okay. So, sorry, where was I? So alongside those kind of the standards themselves, companies are also encouraged to use guidance from industry and the SASB standards to help them do this practically according to their sector and the different types of risks that they want to consider. So again, we know this will be easier to understand with an example. So let's add some color here to see what this could look like in practice. So our first example here is from Mondi Group in their integrated report. And Mondi Group is a multinational paper and packaging company, and they operate across Europe, North America, and Africa. So in the left-hand side of the disclosure extract that we have here, we see a summary of their overall risks that they've identified for their organization, aligned to 4 key categories of strategy, finance, operational, and compliance risks. And so they also identify the designated risk owners for each of these risks, which is helpful. And there's a lot more information about these risks described in the detail of the report itself. And so on the second half of the screen, on the right-hand side, we see that climate change was identified as one of their principal risks in the strategy component. And then what they've done here is broken out then those different types of climate risks that they expected to see. So both the physical risks, the transition risks, and the climate-related opportunities as well. And it's something we'll come on to describe more in a second, but it's also worth noting that they do provide transparency in their disclosure about the estimated financial impacts that they expect to see for their climate-related risks and opportunities, and as well the time horizons under which both the effects of the risk will start to materialize and when they'll be felt at their fullest as well, which is useful potentially to consider as a way of disclosing that. And so as I started to mention there, another aspect of risk and opportunity identification that is important brings us back to what we talked about at the beginning relating to time. And so you might remember that we discussed earlier that the time factor can be quite different when we're talking about sustainability related disclosures. So let's make sure we're clear on what we mean by time horizons. So the standards are asking you to identify within what time horizon any material effects are expected to occur. And so how you define short, medium, and long-term horizons will vary between companies and depend on a number of factors. So for example, your investment and business planning cycles, the strategic horizons of your organization and capital allocation horizons, maybe the lifespan of any assets that you're operating, or also the assessment periods of your investors as well. So the time horizons that you develop should take into consideration the relevant factors for your organization here. But what's important to remember is that you do need to define what those time horizons are. So if you just talk about short and medium term without providing that quantitative definition, your investors won't necessarily know what you mean. And so you can take a look at maybe companies in your sector or industry guidance or the horizons framework that we see here as potential sources to help you identify the right time horizons for you. So moving into the second aspect of disclosure in the strategy category. So firstly there we talked about the identification of risks and opportunities. And then the next step of the disclosure requirements is to disclose the effects of the risks and opportunities and where those occur in the business. So to start tackling the disclosure requirements for this area, companies will want to think about asking themselves questions such as, what would the effect be? What response plans or mitigation actions have or could be taken to address those risks and opportunities? And what are the different types of effect? So maybe you have one risk that might have more than one effect for different aspects of the business as well. So important to start to think about that internally and think about what you can disclose on that front. So again, looking at an example here, we're drawing here from BASF, which is a global chemicals company. And this disclosure from their annual reports from 2024, we're using to show how they've summarized the effects of different sustainability issues on their business model and their value chain. So they illustrate here some of the projects that form part of their company's sustainability strategy. And this includes supplying customers with products that contribute to sustainability through the use or through their reduced carbon footprint. So the company is particularly prioritizing projects where they're seeing rising demand from customers and a willingness to pay more for sustainability products. And they also have a focus on operational transformation products that will improve the company's license to operate and improve its operational efficiency as well. And so we're seeing kind of broken down by the different value chain phases of the company's business model, from its upstream to its own operations to its downstream, the different areas where they've identified connections to sustainability related risks and opportunities and what they're doing to address those. And in the commentary alongside this kind of just summary visual, they talk about also how they're aiming to target more sales revenue by 2030 from products that contribute to transition to a circular economy. So it's kind of illustrating really how the company's sustainability strategy affects aspects of its business model and value chain across the board, and that they're connecting then between the sustainability targets they've set themselves, the overall company strategy, and the financial estimates that they put in place for their business as well. Okay, so sometimes one of the obstacles we know that companies can face when they're reporting on these effects is the level of detail that needs to be disclosed. And in that example that we just looked at from BASF there, we were mostly showing you qualitative information and descriptions. But what about quantitative disclosures? So companies are asked to disclose both quantitative and qualitative information about the current and anticipated financial effects of sustainability risks and opportunities. However, the S1 and S2 standards do also set out criteria for when only qualitative information is required, or a mix of qualitative and quantitative information would be acceptable. And so these reasons include if a company cannot separate the effects of a climate-related risk or opportunity from other effects, if there is a high level of measurement uncertainty, or if the company doesn't yet have the skills, capabilities, or resources to provide that quantitative information. So a number of options there if providing that quantitative information is too challenging. But of course, if your organization does have access to quantitative information relating to these risks and opportunities, it is important to be transparent about that as well. Okay, so that brings us into the last part of the strategy component there. So firstly, we looked at identifying the risks and opportunities that are going to affect the company. Secondly, we looked at disclosing what those effects are across your value chain. And now this final group of disclosures is looking particularly at how the company prepares for uncertainties and ensures its resilience into the future. And so this really gets into the practices and processes that a company has in place to assess its own resilience and make strategic adjustments where it needs to. And so disclosures here will include information on the types of assessment that have been used, and in particular, how and whether climate scenario analysis has been used. And so overall, companies are asked to assess their resilience and to disclose what the inputs and key assumptions are that have informed that assessment. So we'll dive a little bit deeper into scenario analysis in a moment. But some of the starting questions here for companies will be thinking about what is the company's overall capacity to adjust or react to potential uncertainties and to those sustainability risks and opportunities that you've described already. And thinking then about maybe how you could use tools such as scenario analysis to better understand this. So maybe you can identify what the questions are that you need to ask yourself to better understand and manage your resilience. So moving into a couple of quick examples for this segment. Firstly, we have Stora Enso, which is a Scandinavian forest products company. And they show us in these diagrams here the transition that they're expecting to see in their business as a result of sustainability issues and how they're really repositioning their organization for long-term strategic resilience. So we see in the top visual that they have kind of a traditional business in the middle there, which is focused on forests, pulp, and traditional wood products. But that actually for the future, they've identified that a lot of their growth as a business is going to come from sustainability considerations. So sustainability building solutions, renewable packaging, and biomaterials innovation as well. And then what we see in the bottom visual is actually the projection in how that's going to play out for their sales revenue. So they show that back in 2006, the vast majority of their revenue was coming from those traditional forest products, and that's already shifted today to be about 50-50, but that by 2030, these new growth areas could make up 80% of their revenues. And that's partially as a result of growth in revenues from those new areas, but also a potential decline as well in the revenues from their traditional activities. Also, alongside these visuals, they explain in their reporting some of the activities they're taking to proactively reposition their business and capitalize on those opportunities to improve their long-term resilience and strategy. So, for example, they're looking to acquire new businesses that support their growth strategy. They're looking to convert their machinery and invest in innovation now for those opportunities in the future as well. And our second example here comes from Solvay, which is a Belgian chemicals company. And in particular, this example is used to illustrate how they report on the assumptions behind their climate scenario analysis and the financial effects of that scenario analysis. So in the top half of the extract, they disclose to us the tools that they've used to conduct their scenario analysis. They explain which scenarios they've selected, the sources that they've used to draw from those scenarios, from the IEA, International Energy Agency, and some of the key assumptions that sit behind the scenarios. And then in the second half of the extract on the bottom of the screen, they also disclose then some of the financial impacts that they're expecting to see for the different sustainability or climate transition and risks that they've identified. So they use a qualitative scale from a -3 to a +3 to indicate the direction and magnitude of financial effects that they're expecting to see for those different risks. So hopefully a useful example as well. Okay, so just to wrap us up on this section, I've got a quick poll question just to test whether you heard one of the points we talked about there a little bit earlier in the section on disclosing qualitative or quantitative information. So we talked about a number of reasons why it might be acceptable for companies to disclose only qualitative information about risks and opportunities, or maybe a mix of qualitative and quantitative. So let us know how many of these you think are valid reasons for disclosing that information. So you can select more than one answer here if you think more than one is correct, but it's either if the company cannot separate the effects of a climate risk and opportunity from other effects, if there's a high level of measurement uncertainty, or if the quantitative information sheds a negative light on the company. So I'll just give everyone another few seconds to participate. Sorry, I know we have to move a little quickly on the polls, and they sometimes take a bit of thinking through, but just a little conscious of time. So I'll give it another 5 seconds or so, and then we'll show you the correct answer here. Okay, let's stop the poll there, and I'll share with you the results. So indeed, most of you who responded got this one correct. The top 2 options there are both correct reasons why quantitative and qualitative information could be disclosed in a mixed way, or just qualitative information. And as most of you identified, the third option there is not a correct answer. So of course, it's important that we're balanced in disclosing negative and positive information to our investors. So if you did have quantitative information that indicated a potential negative financial effect, it is important that you do disclose that, as well as that growth information. So you saw that in a number of the disclosure examples there, that those were organizations were providing both of those things. Okay, fantastic. I think we're getting started now on the climate aspect of this, which Lois will take us through.
Thank you, Fiona. Yes, well, we've already looked at some of the content requirements, including governance, haven't we? But with the strategy content requirements, there are additional requirements that relate to the climate standard specifically. So with governance, S1 and S2, very, very similar. With strategy, there are some climate-specific considerations that we're going to look at now. Now, this slide is titled TCFD to ISSB, but if you haven't used TCFD recommendations, don't worry, because this list applies regardless. So what do we find in IFRS S2? Well, S2 requires a company to refer to and consider the applicability of industry-based disclosure topics when identifying climate-related risks and opportunities. And the industry-based guidance can be found on the IFRS Foundation website, and it sets out what sort of sector-specific topics you might want to consider. So, for example, if you're in certain types of product manufacture, you might need to think about where you source things like palm oil and whether it's certified. Secondly, S2 requires detailed information on where in the business model and value chain risks and opportunities are concentrated. So there might be a particular product line that's affected by climate change, or there might be particular physical assets that are subject to physical climate risks. Thirdly, the S2 requires details about how a company has responded to and plans to respond to the effects of climate-related risks and opportunities. And that response could include the development of a transition plan, which we're going to look at in a moment, or how the company plans to achieve climate-related targets. Next, in providing disclosure about the current and anticipated financial effects of climate-related risks and opportunities, S2 sets out criteria for when quantitative and/or qualitative information is required for disclosure. So, in some instances, only qualitative information has to be provided. For example, where a company cannot separately identify the effects of a climate-related risk or opportunity, or when the measurement uncertainty involved is so high as to make quantitative information not very useful. The standard recognises that some of the information it requires can be quite difficult to find and supply, and therefore when preparing disclosures on the anticipated financial effects of climate-related risk and opportunity, S2 states that a company is only required to use all reasonable and supportable information available at the reporting date without undue cost and effort, and using an approach that is commensurate with their circumstances. And we'll hear this phrase repeated during the presentation today and explain more about what it means. The S2 does require companies to use scenario analysis for the purpose of assessing its resilience to climate-related risk and opportunity, but the standard does not specify which scenario or scenarios the company must use. That is for the company to determine. And finally, having assessed its resilience to climate-related risk using scenario analysis, S2 requires information on resilience, including things like what significant areas of uncertainty have been considered, whether and to what extent the company has the capacity to adjust and adapt its strategy and business model over time, in order to enhance or remain resilient, and also how and when and which scenarios were used for the resilience analysis. So I mentioned that one of the responses to the effects of climate-related risk and opportunity on a company can be to develop a transition plan. Now, just to be clear, The standard does not say that a company must have a transition plan, but if it does, then it has to provide information about it. So what is a transition plan? Well, it's defined in the IFRS S2 standard as an aspect of the company's overall strategy that includes targets, actions, or resources for the transition to a lower carbon economy, including, for example, greenhouse gas emission reductions plans. So as it is an aspect of the company's overall strategy, the transition plan should be aligned with the company's business strategy, including the business case for the strategy, the motivation for it, any decarbonisation levers that are most economically and technologically feasible for the company. So as we saw in the BHP example earlier, there should be integration and alignment between the climate risks and opportunities and the overall strategy. The transition plan should also align with goals of science, including what science says about the requirements for net zero to be achieved and how carbon neutrality or Paris aligned goals are explained and to be met in terms of science. The plan should include long-term transition goals supported by activities and targets to achieve those goals and interim targets to monitor progress. The transition plan should be transparent about what dependencies, risks, challenges of executing the plan are associated with it. It's looking to the future, so of course there will be uncertainties, and the plan should also explain how any residual or unabated greenhouse gas emissions will be treated. On the penultimate point, the transition will proceed in different ways for different sectors, and therefore it's useful to look at sector-specific pathways for how the transition will unfold for different industries, and we'll look at some resources that can help with that in a moment. And finally, companies should be aware about how their transition plans will be evaluated by investors and others, and therefore check that their plan has the hallmarks of credibility, and those are actually set out in the Sustainable Stock Exchange model guidance on transition plans, which we'll show you in a moment. So yes, resources. There are lots and lots of resources on transition planning. We can only show you a few here. The triangle on the left is designed to show that whatever the resources, whether they're developed by the by GFANZ, which is the Glasgow Financial Alliance for Net Zero, or the Transition Plan Task Force, the resources are all designed to work together and to support the IFRS sustainability standards. And talking about the IFRS Foundation and their standards, they very recently, I think it was just in June, developed an IFRS guidance document on disclosing information about a company's climate-related transition plan. So do have a look at that document. Also, as I just said, the SSE has its own model guidance on climate transition plans, which lists lots of resources that could help you. We see third from the Glasgow Financial Alliance for Net Zero that they've set out sectoral pathways for the transition for financial institutions, but also expectations for real economy companies. And although now within the IFRS Foundation, you can still look via the IFRS Foundation website at the Transition Plan Task Force Disclosure Framework, which also has very useful resources for transition planning and transition plans. So having been through the climate-specific aspects of the strategy requirements, we're now going to take a short break. We're halfway through. So we're going to play you some relaxing music for 5 minutes. During that time, take the opportunity to have a stretch, have a drink, and think of any questions you'd like to ask us. Pop them in the Q&A box and we'll be happy to answer them. So see you back here in 5 minutes. Hello, everyone. Welcome back. I hope you had a good break, a chance for a drink and to energize yourself for the next section. So we're going to turn now to the next core content area, which is risk management. And this category of disclosures asks report preparers to disclose information on their processes for risk management and how those processes fit into their overall risk profile. So the sorts of questions that you might want to ask within the organization to help prepare for disclosures in under this core content area are to look at what processes and policies are currently being used to identify, assess, prioritize and monitor sustainability related risks and opportunities, and how sustainability related risk and opportunity management is integrated into the company's overall risk management process. So in more detail, you might want to look at what inputs and parameters are used for risk management, what criteria are used for assessment and prioritization of sustainability related risks. Are they criteria like nature, likelihood or magnitude of risks? And also look at whether and how processes have changed since the last reporting period. Of course, sustainability related risks and opportunities have different characteristics to other risks, and therefore we can't assume that the policies and processes within the company used for general risk management are appropriate in all cases, but at least they give you a good starting point. So let's think about the climate-specific considerations in relation to risk management. Again, we see the title TCFD to ISSB here, but don't worry if you haven't used TCFD because these principles apply to in all cases. So S2 requires a company to provide detailed information about the input parameters it has used to identify risks, whether and how climate-related scenario analysis informs risk identification. It's primarily for resilience analysis, as we saw, but can also be used for risk identification. And as I said earlier, whether and how risk management processes have changed. The similar principles apply to sustainability-related opportunities. In the case of climate-related risks, the S2 standard does set out a definition of climate-related risks. And there are two main types, transition risk and physical risks. Transition risks arise from efforts to transition to a lower carbon economy, and they're often categorized as policy and legal, technological, market, and reputation risk. We've got some examples of these types of risks in the middle of the screen. Transition risks could include increased pricing of GHG emissions, more reporting obligations, exposure to litigation, costs associated with the transition to new lower emission technologies, changes in consumer behavior and needs, uncertain market signals, increased costs of raw material, changes in availability, and so on. So lots of different examples of transition risks. Physical risks include risks from climate change that can be event-driven. These are acute physical risks that arise from weather-related events such as storms, floods, droughts, or heat waves, which are sadly increasing in severity and frequency, or chronic physical risks. These arise from longer-term shifts in climatic patterns, changes in rainfall and temperature, potential sea level rise, changes in water availability and quality, biodiversity loss, and changes in soil productivity. Now, in all cases, these climate-related risks can give rise to financial effects, financial implications for the company, affecting operating costs, asset impairment, and other financial effects that manifest in changes to cash flow, access to finance, and cost of capital. And of course, these financial effects manifest over different time horizons, the short, medium, and long term. Similarly, in S2, we have a definition of climate-related opportunities, and these are the potential positive effects arising from climate change for a company. So these opportunities include efforts to mitigate and adapt to climate change, and can include things like innovation, resource efficiency, changing to lower emission sources of energy, encouraging supportive policy incentives, developing new products and services to adapt to consumer needs and preferences, perhaps accessing new markets, and certainly enhancing the resilience of the company through these opportunities. Again, these opportunities will have financial effects on the company's hopefully increased cash flows, maybe changes in access to finance or cost of finance and cost of capital. And again, those opportunities and the financial effects will manifest over different time horizons, the short, medium, and long term. Let's have a look at an example now about risks and processes associated with risks. This is from a company called the RS Group. It's a UK-based distributor of electrical and industrial equipment with global operations. This company, RS Group, have analysed their climate-related risks and opportunities for a number of years. And elsewhere in the disclosure, not this extract, but elsewhere, they identified 10 principal risks. And they include, one of those includes climate-related transition and financial and physical risks to their business. And this extract is focused on some of the physical risks. So the company's most significant physical climate risks relate to the impact of extreme heat on their distribution centres. You can see that on the first line there, item 4, and the potential for extreme weather events to cause physical damage and disruption to their customer supply operations. And you can see that on the second line, item 5. So you can see in both cases, there's a little red wheel icon, and this shows the connection between the physical risk that they've identified and their strategic plans. You can also see some little stakeholder icons, and this tells us the connection between the physical risk that's been identified and the stakeholders that may be affected by the risk. In this extract, you can also see that the company has described the risk. They identify the business owner who is responsible for managing the risk. They tell us the metrics that they use to monitor progress of the risk. And they also tell us the actions that they're taking or planning to respond to the risk. For example, building upgrades and associated capital investments and business continuity planning. So quite a lot of information about that process and the identification and management of risk there. So we're going to hand over to Robert now to take us through the next core content area. Over to you, Robert.
Perfect. Thank you very much, Lies. Yes, indeed, we'll be moving to the next section of our training. So we discussed now, we'll be now moving to the metric and targets, so another core content area. Let me move the slides. Sorry, I think I have trouble. Yes, apologies for this. Yes, so I'll be moving to the next section to the metrics and targets. I'm sorry, the slides were flipping. So we're now on the right slide. So we'll spend some time reviewing the disclosure requirements on metrics and targets in more detail. And indeed, we're moving to the fourth content area, metrics and targets. So let's start with metrics. So requirements on metrics are designed to enable investors to understand companies' performance in relation to its sustainability-related risks and opportunities. So preparers shall disclose information explaining how the metrics are defined, if they're absolute or relative, if they have been validated by the third party, as well as the methodology. So what is the method of calculation? What are the inputs? And what are the limitations and what are the assumptions involved? So that's about the metrics, and similar questions as need to be asked regarding the targets. Requirements on targets are designed to enable investors to understand the targets a company has set to monitor progress towards achieving its strategic goals. So disclosures would then include whether the targets are qualitative or quantitative, and whether it is set voluntarily or by law or regulation. The metric used set the target to monitor progress towards its achievement. It's obviously essential component of the target disclosure. Additional one, another one is the baseline period from which progress is measured, and the period to which the target applies. If there are interim targets and milestones, they also should be disclosed. And if there have been any revisions to a target with the explanations about the revisions, should be also part of the disclosures. And to that topic, metrics and targets, we will have another example. And again, over to you, Lois, to present it.
Thank you, Robert. And this example is from a company called CLP, which is one of the largest investor-owned power businesses in Asia Pacific, and they aim to be a leading responsible power provider. Now, this example is interesting because you'll have noticed that many of the examples we've shared with you are to do with climate change. This example from CLP is about the metrics that they use for waste management and material use. It's an extract from their 2024 sustainability report, and the metrics you see are about their waste management and material use, including the percentage of pollution that the company reduces through recycling and removal activities. Now, those activities are in line with its strategy, and you can see in the top right-hand panel the company's targets, and also they explain here what their strategy is for supporting a circular economy. So as we were talking about earlier, there's certainly a connection between the metrics, the target setting, and the strategy in this particular case. So something I want to note here as well is that you can see in the pale grey writing in the top left panel that the metrics have been calculated using SASB and GRI standards. And that's because at the moment there isn't a waste management standard set by the ISSB. So this company CLP are using GRI and SASB. We can see from the results, the 2024 results, that the company is mostly 100% in line with its targets. You see that in the penultimate column there as well, target by 2025, in most cases 100% met. So an interesting example about waste management and circular economy, and the way in which that links to strategy, how the company measures their progress, and what targets they set. And with that, we'll hand back to Robert.
Great. Thank you, Lois. Right, we'll now moving to the, again, we'll be staying with metrics and targets, but we'll then focus on the climate considerations. And so we'll talk about a bit more detailed in that regard. So let's then talk about TCFD. We already mentioned that the IFRS standards has been built based on TCFD requirements. But IFRS S2 takes that further by making some of these mandatory. So under IFRS 2, companies now need to disclose industry-specific metrics that reflect their business model and operations. These are designed to help investors understand how climate risk shows up in the real activities of a company. Beyond that, there are new requirements for greenhouse gas emissions, not just overall numbers, but also details about emissions from the consolidated group and where relevant, joint venture and associates. So for financial institution, that also includes finance emissions as well. So there is a dedicated framework for Scope 3 greenhouse gas emissions built into IFRS S2 to help guide consistent and decision-useful disclosure. On the last point, while IFRS S2 doesn't explicitly say you must break down emissions by gas like CO2, methane, etc., IFRS S1 includes disaggregation requirements. So if showing those gases separately gives investors material insight, then yes, they should be disclosed. All right, and in regards to the targets and how that's reflected in TCFD and now in IFRS sustainability disclosures. For example, here IFRS S2 requires disclosures about how the latest international agreement on climate change has informed the target and whether there has been validated by a third party. IFRS S2 also requires disclosures of more detailed information on greenhouse gas emissions, including additional information about any planned use of carbon credits to achieve a company's net greenhouse gas emissions targets. Also, IFRS S2 includes additional requirements to disclose information about the approach to setting and reviewing each target and how it monitors progress against the target, including whether the target was derived using a sectoral decarbonization approach. So that's how this works under S2, these metrics and targets related to climate. Now we will touch on a bit more on greenhouse gas emissions, as this is one of the most common topics that comes up when we talk about metrics and targets under S2. So just to recap, for anyone newer to this space on the scope 1, 2, and 3, what this means. So scope 1 covers direct emissions, so things like your own facilities or company vehicles, they'll be included in scope 1. In scope 2 covers indirect emissions, and that's mostly from purchased energy like electricity or steam for heating, etc. Scope 3 is everything else across your value chain, so things suppliers, distribution, and also product use. And IFRS still requires companies to disclose all three topics, gross absolute emissions using the Greenhouse Gas Protocol corporate standard. There is some flexibility here though. So if your local regulator requires a different method, you can use that in the first year thanks to the transition relief. You will also need to disclose if you use an internal carbon price to guide decision making and whether executive compensation is linked to climate performance. So just recently, or not super recently, but not a long time ago, in May 25, the IFRS Foundation published a really helpful Q&A style educational piece on how to meet these disclosures requirements, especially around scope 3. So we do definitely recommend taking a look if you haven't seen it yet. And I'll then hand over to Fiona for the... Oh no, we have another example, so that's Lois. So over to you, Lois, on how to disclose the greenhouse gas emissions. Over to you.
Thanks, Robert. Yes, and this is an example from Enel, which is an Italian producer and distributor of electricity and gas. There's lots of different ways in which you can disclose greenhouse gas emissions. Enel chooses to do it through a GHG inventory, which is a separate document that sets out both their strategic ambitions on greenhouse gas emissions and to achieve net zero emissions by 2040, but also their strategic ambition to promote energy generation from renewable sources. So this is an extract, one of the ways in which they disclose their GHG emissions. And at the top, you can see the company's carbon footprint broken down by scopes 1, 2, and 3 greenhouse gas emissions. Now, the shaded graph bars show the emissions for 2022, and the dark blue graph bars show the emissions for 2024. So immediately, this graphic shows us the pattern. The pattern is a reduction of all types of greenhouse gas emissions, scope 1, 2, and 3, from 2022 from 2024 compared with 2022. So you see the trend. But you can also see where the majority of emissions come from. And the tallest graph bars being scope 3 emissions, we can see that scope 3 is the main source of greenhouse gas emissions for this company. At the bottom of the slide, we can see an extract showing partly how the company breaks down its scope 2 greenhouse gas emissions. So they break this down by activity. You can see that in the first column in the bottom panel, and activity from power generation and other activities. We can see the breakdown by source, so from electricity consumption from the grid in power plants, and from electricity consumption from the grid in terminal ports and other locations. Again, we see the comparison between years, between 2022, which is the baseline, and 2024, and the percentage reduction. We finally see a breakdown between the different scope 2 calculation methods, which are location-based and market-based. Now, scope 2 is the only scope where there are these two different calculation methods. The location-based method reflects average emissions intensity of the local electricity grid that the company is connected to, and market-based emissions method reflects emissions from electricity based on the contractual terms that the company has entered into. So let's have another Zoom poll now. And the question is, what is the objective of metrics? And in particular, what is the objectives of the metrics requirements set out in the ISSB standards? So you can pick as many answers as you think are correct here. Is the objective to understand performance in relation to the entity's sustainability-related risks and opportunities, to understand progress towards targets, or to understand the company's assumptions for the future? Give you a moment to think about that. In the interests of time, I'm going to just show you the results now. And you'll see that most of you selected A and B, and that's actually correct. For those of you that said that the metrics would help readers understand the company's assumptions for the future, of course, that's right as well. But the reason we asked you the question in this way is to encourage you to read the standards. In paragraph 45 of IFRS S1, the objective of the metrics requirements is set out, and that objective is to understand the company's performance in relation to its sustainability-related risks and opportunities, and to understand progress towards any targets. Of course, it might also help with understanding the company's assumptions for the future, but we ask you this way to encourage you to read the standard and how it explains the objective of each of the requirements. So we're going to move on now to another part of the module, and this is about what happens when you want to make additional disclosures, that is additional to the requirements in the ISSB standards. Well, we've already explained, haven't we? So I won't go through this, that the ISSB seeks to set out a baseline for sustainability disclosure. But you can have building blocks on top of that baseline, which are based on things like listing requirements or information needed to understand how the company may benefit from policy objectives and incentives, such as tax cuts or subsidies for sustainable practices. There may need to be building blocks on top of the baseline to encourage or require companies to provide information about things that affect their particular industry, particular sustainability related risks and opportunities for that sector, or to satisfy the information requirements of other stakeholders, for example, on impacts as well as risks and opportunities. But how do you do that? Well, it may be because company jurisdictions have set their own additional building blocks, and the ISSB is working with jurisdictions around the world to help them with their adoption or other use of ISSB standards. So as of June 2025, 36 jurisdictions had adopted, used, or were finalising the adoption of ISSB standards. And the ISSB also has published jurisdictional guidelines and other materials to show how and where countries are adopting or consulting on adoption or perhaps voluntary use of ISSB standards. And the ISSB and IFRS Foundation are working with jurisdictions around the world through various processes, and they have various tools such as the Regulatory Impact Programme and the Roadmap Development Tool. So we've given you links to all of those processes. So if you are thinking of or actually responding to the ISSB's requirements, but also using other frameworks, how does this work? Well, I explained at the beginning that CDP has aligned its climate questionnaire with S2. We know that the Transition Plan Task Force materials are now the responsibility of the IFRS Foundation, insofar as they relate to disclosure. We'll look at GRI's relationship in a moment, but two things to note here, which is that the Greenhouse Gas Protocol, which is the standard that must be used for the calculation of greenhouse gas emissions by the GHG protocol team, works closely with the ISSB, both on technical developments, but also on governance of the organisation. The ISSB has a project on biodiversity and ecosystem services, and they're looking at the work of the Task Force on Nature-related Financial Disclosures to consider how that can help to develop educational material, for example. We talked earlier about the fact that GRI works closely with the ISSB. The link you see on the left there is quite an old document now, dating back to 2024, showing alignment between the GRI standards and ISSB standards on GHG reporting. But since then, as you'll see on the second bullet point on this slide, the GRI and ISSB has confirmed that the GRI Sustainability Standards Board has granted equivalence to S2 climate disclosures for Scope 1, 2 and 3 emissions under GRI Standard 102. And Fiona's helpfully just provided us with a link in the chat to that particular announcement. But what it means in practice for reporting companies is that you don't need to do two sets of greenhouse gas emissions reporting, one GHG emissions reporting and calculation now will be treated as equivalent by GRI and ISSB. The two organisations, GRI and ISSB, are also working to deliver interoperability on biodiversity and ecosystem services, so that in their project on biodiversity and ecosystem services, the ISSB is looking at GRI's 101 biodiversity standard to see how that can help with the development of the ISSB's work. and the IFRS Foundation was a convening partner of GRI's Sustainability Innovation Lab in Singapore. So the two organisations work together closely to try and jointly identify common disclosures and to align requirements as far as possible. Maybe not so much for this audience, but those report preparers that are or could be in future subject to European reporting standards under the Corporate Sustainability Reporting Directive may be considering what is the alignment between the ISSB standards and European sustainability reporting standards set by IFRAG. Well, again, the high-level message is that the two organisations work closely together to try and give as much interoperability, as they call it, and alignment as possible. They've already found that their climate-related disclosures are highly aligned. The main differences between them, though, are to do with their different objectives. So ISSB very much focused on the information needs of investors, and the European standards are designed to elicit information for a wider stakeholder group. So European standards ask for information on impacts as well as risks and opportunities. So again, we see that there were some of you said at the beginning you were using integrated reporting. And we know that the integrated reporting framework has been consolidated into the ISSB's work, but the framework still exists and provides a principles-based guidance for reporting structure and content that is complementary to ISSB S1 and S2. So when used together, the ISSB standards and the integrated reporting framework can help companies give a holistic and strategic view of their value creation process and a more complete picture of how value is created over time. If you'd like to know more about using the ISSB standards and integrated reporting framework together, the thumbnail on the left shows you a getting started guide, which includes frequently asked questions and a mapping tool. But the most important thing perhaps about integrated reporting is that it's underpinned by integrated thinking, which is a method that can very much enhance the quality of a company's corporate governance. Let's have a Zoom poll now to see how we've taken this in. So, when considering your company's disclosure objectives, should you take account of the ISSB standards only, the ISSB standards and regulatory requirements, just regulatory requirements, or the ISSB standards, regulatory requirements, and other sources of guidance? I can see from the statistics that you all know the answer to this question, so I'm going to share the results with you now. Of course, it is the answer D. In considering your disclosure objectives, you should take account of the ISSB standards, regulatory requirements, of course, but other sources of guidance like the ones we've described, GRI, integrated reporting, European standards, and so on. So well done for getting that question right. And we're going to hand over to Fiona now, who's going to take us through a summary of Module 2.
Brilliant. Thank you so much for that, Lois. And as you say, that brings us up to the end of Module 2. I do always like to reassure everyone that Module 2 here is our largest section of content. As you saw, we were really getting into the align aspect of those different content requirements and wanted to make sure we had good time to cover that with you. So please rest assured we're well more than halfway through the session, but have covered a big share of the content in Module 2. So well done for that. So to wrap up this module, we'll take a minute to remind ourselves of what we've learned. So we talked, of course, about those 4 core content areas of the ISSB standards: governance, strategy, risk management, and metrics and targets, and took you through the disclosure requirements of each of those and some examples of companies and how they're reporting against those aspects currently. And so an important thing we want you to remember here is that, of course, whilst we talk about these as 4 separate disclosure areas, of course, they don't operate separately within an organization. So Of course, you need to be thinking in an interconnected way internally about how you connect between those different aspects of what you're doing. And then in this module, we also discussed how your disclosure might go beyond the requirements of S1 and S2. For example, to meet the needs of different stakeholders, to meet regulatory requirements in certain jurisdiction, or to meet industry standards, as Lois took us through a range of options on there. And what we want to remember here when we're doing this is that the ISSB standards have been developed to act as a baseline. And so that building blocks approach that we've talked about will allow report preparers to add additional disclosures on top of that baseline where they need to or choose to do so. However, what's important to keep in mind when we're doing this is that we shouldn't obscure the requirements of S1 and S2 either. Okay, so to wrap us up on this module, we'll be going back to Menti now for another reflection question and exercise together. And so the second exercise is bringing us into the next aspect of that disclosure plan that we were talking about, which is all around understanding what the key gaps are that you need to address in your current disclosures or internal processes to prepare you for alignment with the standards. And of course, to support this, we'd recommend that after the session, if you haven't already done so, you aim to conduct a fuller gap assessment to understand the full suite of what those gaps are. And if you go to the homework exercise, there's a simplified checklist that can be used to help you get started with this. But we'd like to just take a moment now to reflect maybe on what you've heard so far, what's front of mind for you about some of the key gaps that you think you might have that would feed into this plan. And so you might want to think here about content requirements. So maybe there's particular pieces of information that we've discussed or disclosure topics that you're not necessarily reporting on at the moment. Or maybe the other aspect as well could be your internal processes and your resourcing. So maybe there's things that you think you need to adjust or develop in your internal processes and your organizational capabilities and skill sets to better prepare you for this reporting. So let's take a moment just to reflect on that together. I think there's sometimes safety in numbers in knowing that many of us have similar challenges that we're grappling with in our organization. So part of this is about sharing that and knowing that we're not alone, but also maybe good just to reflect on what do you think your key gaps and priorities are, and maybe seeing what others have to say on that as well, if they're thinking of anything that maybe you haven't thought of yet. Okay, so thanks again for lots of responses on this. It's great to have lots of answers to talk through together. So someone has mentioned here that they're focusing currently on regulatory compliance, but they lack an integration of broader sustainability standards. So yeah, indeed. So maybe you have a slightly narrow focus at the moment in what you report, and the fuller breadth of what you would need to disclose here will require some kind of fuller thinking and development to address. Someone else has mentioned maybe the financial impact assessment. Indeed, we know for many organizations that is a new aspect here. So we've talked a lot, obviously, about the importance of connecting between those sustainability risks and opportunities and their financial effects. But for many organizations, that is a new thing to get to grips with, indeed. Someone's mentioned maybe additional costs, for sure. So maybe you need to recruit new resourcing to support you to adopt these requirements, or additional assurance needs, for example, as well. And so I think when you're making the case internally for more budget to support you here, it's important to try and highlight as well, not just those compliance drivers, but the real demand for this information from your investors, and also the potential opportunities and benefits there could be to disclosing this information in terms of access to capital, improved competitiveness, etc. as well. Someone's mentioned that maybe they don't have anything material to disclose. So interesting. I mean, I think if you refer to the standards, you'll see that quite a lot of aspects of the disclosure should be provided regardless of materiality, for example, relating to your governance. But we'd encourage you as well not to dismiss sustainability risks and opportunities too early as immaterial without having necessarily assessed and fully interrogated that as well, because often it's only when we get into thinking about those deeper connections and effects from the risks and opportunities that we may not yet have been able to analyze that we start to understand, yeah, even if something is not necessarily material today, if we're looking over those medium and long-term horizons that we need to for these purposes, it's possible that it may be material in the future. Great. So some people have mentioned as well around getting clarity on what issues are most important to their stakeholders and which have the biggest impact. So indeed, conducting materiality analysis can help you I think clarify those processes and priorities. A few people have mentioned as well around maybe the need to build out their policies and their governance processes. Indeed, I think an important aspect of getting the foundations in place for assessing, prioritizing, and managing these risks and opportunities is those sort of foundations of your governance processes. So, as much as you can, I think connecting into what you already have in place within your organization on enterprise risk management should support you here. Okay, fantastic. Thank you for all of the responses here. Someone's mentioned particularly around maybe scope 3, and I see a few answers on climate specific elements relating to needing to disclose climate opportunities and risks, maybe doing a transition plan, as well as the emissions. So yeah, digging into the requirements of S2 as well. Okay, and then connecting between the standards as well, as someone has mentioned. So hopefully referring to those interoperability mappings that we've shared with you could assist there. And we'll share also later some examples of how companies are connecting this in their disclosures. Fantastic. Lots of good responses here. People have also mentioned maybe internal data as well as a problem. So indeed, I think to understand well these different types of risks and opportunities we see, often we might need to gather new data. We may need to understand what is available in the business that we can use to draw from there. So definitely a good starting point. I think one thing we do find and hear from many organizations is that actually there is more data than you necessarily think to help you with this. It might be located with a different team or function. It might be used for different purposes at the moment, maybe operational compliance or reporting, but possibly could be useful to support this process. So worth doing a good exercise and asking questions with your colleagues in different divisions and functions to understand what information they have that might be able to support you here. Great. And someone has also mentioned, I've seen a few responses on sort of knowledge and skills and the understanding of your management and wider employees on this topic. Indeed, all very important. And I think it can feel overwhelming sometimes if you're the individual who's responsible for bringing these requirements into your organization to know how to approach that. So I think as much as you can, spending time with your colleagues to help them to understand the relevance and connection of this to their roles can be very helpful. So, for example, your colleagues in risk, in financial management, maybe in strategy, will have very relevant skill sets that can help you here. I think it's just making sure it's clear to them that this topic is very much relevant and, something to be on their radar. We hope the sort of messaging we've shared today, and we'll share some further resources at the end that you could share with your colleagues on that front as well. Okay, there's more responses than we have time to go through, which is a very good problem to have. So thank you again for all of the input there. I think you've really highlighted a lot of things we'd recommend that you're thinking about here. So hopefully it's been helpful to reflect on what those sort of key gaps are, but as we say, would recommend taking this away and thinking about how you prioritize these things through the disclosure plan. It might be that some of these gaps are quite key to prioritize and address before you report, but maybe some of them as well are things that you can improve and iterate over time as your reporting matures. So just getting a sense of what those gaps are and how you'll prioritize addressing them is something we hope will be quite helpful. Okay, great. I think that's a wrap up on our module 2, and I'll hand over now to Lois to get us started on module 3.
Thank you, Fiona. We've looked up till now about what should be reported because that is the main focus of the ISSB standards. Now we're going to have a bit more of a look at practically how that is done. So what practices and policies do you need to collect data, for example? Yes, processes and practices is what we're moving on to. We've got 3 parts of this particular module. First of all, how you identify sustainability related risks and opportunities. Secondly, Fiona will take us through part of the module on evaluation, particularly in relation to scenario analysis. And finally, we'll describe how to integrate certain processes and practices with your existing processes for sustainability disclosure. So first one, identifying sustainability related risks and opportunities. Well, We know that the S1 asks companies to provide material information on all sustainability risks and opportunities that could reasonably be expected to affect a company's prospects. And S2 sets out requirements for climate disclosures. But what about risks and opportunities beyond climate? What about biodiversity, water, human rights, etc.? Well, S1 directs companies to sources of guidance to support the identification of those types of risks and opportunities, and to support them providing information about those risks and opportunities. So first, when identifying which sustainability-related risks and opportunities to report on beyond climate, the S1 says that consideration must be given to SASB standards. So these are sector-specific standards, and they are actually available from the ISSB website. So you just go and find the SASB standard or standards that relate to your particular industry, and they will give you an idea of what types of risks and opportunities and disclosure topics might be most material and relevant. In addition, companies can consider other materials such as IFRS education material on identification of sustainability-related risks and opportunities and disclosure of material information. So that particular educational material is available on the ISSB website and very, very comprehensive with examples and so on. Companies can refer to the CDSB framework application guidance, which covers a wide range of subject matter, including water, forestry, biodiversity, and human rights. You could look at industry practices, perhaps issued by a trade body, or the materials of investor-focused standard setters. Now, when it comes to having identified the risks and opportunities, what information do you provide about them, and how do you measure it and assess it, etc.? Well, the same sources of information can be referred to, but also companies can refer to the GRI standards and European sustainability reporting standards. And if you remember, we saw an example of this earlier, didn't we, where CLP had used SASB and GRI standards because it was strategically important for them to report on circular economy, waste management, and pollution. So that was an example of doing that in practice. We're going to have a look at another example now from a Philippines-based conglomerate, a huge company called Ayala. They've got lots of different diversified industries, banks, healthcare, technology, and so on. And this extract from their 2024 integrated report shows the way in which they go about identifying sustainability-related risks and opportunities and other risks to the business. And I think somebody had already asked us a question in the Q&A about this. It was Nisa had asked, well, how do you do this when you're a conglomerate? So this is quite an interesting example. First of all, Ayala has a kind of a meta exercise, if you like, by communicating widely and consulting, asking people about the risks and actions that they perceive, getting insights and inputs from a wide range of stakeholders, including senior management, business units, and other stakeholders. So having got that kind of background sense of the risks and opportunities, they then go through a 4-point process. They establish the context within which they need to understand risks and opportunities. So they take account of multiple internal and external factors, looking at their own enterprise risk management team's results as well as looking at the external context. Secondly, they assess the risks that they have identified, and they evaluate them using a range of criteria. They decide how they're going to treat the risk in step 3, and then they decide how they're going to monitor and review the risk. So this is a kind of a comprehensive framework for identifying, assessing, treating, and monitoring risks. Let's have a look at another example, quite a different approach here from a company called Nest. It's from their 2024 annual report, and Nest is a Finnish Finland-based company, and it's a leading producer of sustainable aviation fuel, renewable diesel, and feedstock solutions for the chemical industry. So it's focused on circular and renewable materials and energy sources. In this extract from their annual report, we see that they assess risks under two scenarios. There's the net zero 2050 scenario and compromised climate targets scenario. Now, scenario analysis mainly to be used for resilience analysis, but can help with risk identification as well. So in the net zero world, in which they expect rapid and radical emission reductions to be taken so as to get to global warming of no more than 1.5 degrees over pre-industrial times, they've divided that into two. They look at it across the world and across the EU and North America. And that's, of course, because different jurisdictions take action at different timescales and in different ways. On a global basis, in the net zero world scenario, they expect opportunities to arise from their supply of renewable and circular solutions, and for those solutions to be supported by regulation and voluntary ambitions. Of course, they identify risks as well, and these are associated with competition and the acceleration of new technologies. In the compromised climate target scenario, climate action is slow and global warming of 2.5 to 3 degrees above pre-industrial levels is expected. In that case, the risk is that the demand for the company's product is constrained, but the opportunity is that they can distinguish themselves from other companies. In all cases, the company gives an indicative financial impact assessment of the risks and opportunities in these different scenarios. And of course, as you might expect, the most positive indicative financial impact is in the net zero world 2050, where the company is able to maximize the opportunities that they've identified. Now, I won't go into this in detail because we've already covered it to some extent, but the standards recognise that identifying risks and opportunities can be a challenging exercise and therefore only requires companies to use reasonable and supportable information available at the reporting date without undue cost and effort. So what does reasonable and supportable mean in this context? Well, it means information that is specific to the company, not just general observations about climate and sustainability risks. Reasonable and supportable information takes account of the external environment, and we saw that, didn't we, in step 1 of the IALA process. It includes information about past events and current conditions. Company already knows those, but also takes account of forecasts, and perhaps that was relevant in the nest example where we saw them using scenarios. And in some cases, what is reasonable and supportable is specified in the ISSB standards. We'll hand over to Fiona now for the next part of this module.
Thanks, Lois. Great. So moving in now to the next part of implementation, which is all around evaluating risks and opportunities. So you've worked through with Lois there how to identify them, and now you need to aim to evaluate the financial effects of risks and opportunities. And as we've mentioned a few times already, we know that this can be quite a daunting aspect when first getting started. So let's aim to review a few of the key concepts to help with getting started on this process. So S2 requires companies to disclose information about the implications of climate change on its strategy and business model. And that's really aiming to help investors understand your company's resilience to climate risk. And it also asks for the company's financial and operational capacity to adjust and adapt over the short, medium, and long term. So, for example, your company might want to test its resilience against a new regulation to limit certain high emissions activities, or perhaps its ability to respond to changing crop yields due to more frequent heat waves. And so this is when you're then going to need to use climate scenario analysis. And I know we've had a few questions on this already, so let's aim to unpack this topic a little bit further. And so it's important to remember when we're talking about climate scenario analysis that scenarios are not predictions of the future, they're not forecasts. They're purely projections of plausible possible future pathways. And so the idea is not to ascribe or predict what is the most likely outcome, but to consider how the uncertainty of a range of different futures could impact your organization, and to try to help to build a strategy that's resilient and flexible to how things could change in the future. And so S2 doesn't specify the actual scenarios that a company should use in the analysis, because this is going to be highly dependent on the risk type, sector, geography that you're assessing. But what it asks is that you use relevant scenarios and you provide information about how they have been selected and the relevant assumptions that you've used in the analysis. And S2 also provides guidance to companies on how to determine its approach to scenario analysis. And this will encompass a range of different practices, from starting out with qualitative scenario narratives to progressing into more complex statistical modeling methods. And overall, companies are asked to use an approach that's commensurate with the company's circumstances and that uses all reasonable and supportable information that's available to the company at the time of reporting without undue cost and effort. So again, a lot about proportionality and about applying an approach where you're focusing your most energy and efforts on material issues. So looking again at some examples of how organizations approach this in practice, we have here Nestle, who you're probably familiar with, the Swiss multinational food and drinks company. And what we see here is one output from their climate scenario analysis that they included in their 2024 non-financial statement. There's a number of different outputs and assessments they conducted, but this visual in particular shows the potential impact of physical changes in the climate on the yield of 12 of their key agricultural commodities. And they're projecting out to 2040 under a medium emission scenario analysis, what changes they could see from a positive or negative effect on crop yields across different parts of the world. And what the analysis shows is that there's a potential that increases in heat waves, droughts, and water stress from changes in the climate could affect the availability and quality of a number of the key raw materials that they rely on. And that in turn could lead to a number of different business risks, from increased price volatility and input costs to stability of their supply chain as well. And in the reporting alongside this, they go on to summarize the key outcomes of their analysis for different areas of their business and some of the steps that they're taking as a result of this assessment to try and increase their resilience. So, for example, they're exploring opportunities for product innovation, to invest R&D as well in leveraging crop science to improve yields and the resilience of the crop commodities that they grow. So overall, an interesting example of how they're then using that insight from the analysis to inform their own strategy and build a more resilient pathway forwards. And so we know, of course, that when we're talking about future events, anticipating the materiality of this could be very challenging. And so to help with this determination, IFRS S1 provides a list of a number of issues that you can use to help you with your determination. And this list here is around identifying the different steps and information that you need to continue to assess the uncertainties and the judgments required to make these disclosures. And so what you're asked to do is disclose any uncertainties that relate to future cash flows and to evaluate them. And another important point to mention here is that this is something that should be revisited each reporting period. So it's understandable that there will be these uncertainties, but what's important is that you're being transparent about what they are and how you're continuing to assess and update your understanding there. Okay, so that's the evaluate aspect, and back over to you, Lois, for integration.
Thank you, Fiona. So the good news about this part of the training is that, we think you'll find within your own companies that you already have lots of processes, systems, and practices that can help with the development of your sustainability disclosure practice. And we're going to look at how you assess them. So when you're looking at whether and to what extent and how your existing systems and processes can help with this sustainability disclosure, here's a list of things that companies can consider. Well, first of all, we've already talked about this, a gap analysis. Are there systems and processes in place to deal with all of the types of things you might want to or have to report on? Secondly, how suitable are your existing processes and in terms of the criteria applied for assessment of risks? So, as we've already said, sustainability related risks and opportunities have different characteristics from other risks and opportunities. They manifest over different time horizons and perhaps are a great deal more uncertain and linked with other things. So, are the criteria that you use suitable for prioritizing them, or do you need to take account of other criteria in addition to likelihood, impact, vulnerability, and speed of onset? You could look at what controls systems you already have in place, internal controls, and whether they are suitable for helping with sustainability disclosure. Importantly, let's talk about people. Who are the people and departments and experts that have relevant processes, systems, data flows, and expertise to contribute to your sustainability disclosure? You'll need to take account of interconnections between different internal and external factors and how they affect your assessment of sustainability related risks and opportunities. And we saw that, didn't we, in the IALA process? Internal and external factors taken into account. Of course, there will be uncertainties, and you might want processes in place to decide how to deal with those uncertainties. So what are the parameters within which you decide that something is so uncertain that you will or won't report on it? And finally, what resources are in place to manage or develop new and existing systems and processes? And do you need to go through a budget approval or change management process to change or renew anything? So we talked, didn't we, about your homework, your sort of non-mandatory homework, which is to develop and use a disclosure plan. But what is a disclosure plan? Well, it is a way in which you can integrate sustainability-related risks and opportunities assessment and development into an organization's practices and processes. It helps you take control of your narrative because it's very specific to your company. So the requirements ask about your strategy, your risks and opportunities. So the disclosure plan enables you to be specific about what's happening within your organization in the context of your company's goals and objectives, including compliance requirements, but also management's communication strategies. It supports internal collaboration, knowledge sharing, and cross-functional team discussions within staff. We already mentioned, didn't we, that there might be systems and processes and experts in your risk management team, company secretarial, procurement or finance that could help with sustainability disclosure. And the plan will help you decide how to coordinate all those different departments and their processes and what their responsibilities will be. And you can also decide and define in your disclosure plan how data will be sourced and how you can use existing systems, controls and processes, and whether you'll get assurance, what will be the sign-off procedures. And this disclosure plan, therefore, by recording all those things, creates a central reference point, an audit trail for you to decide how, where, and when you're going to do things and with whom. We'll look at an example now of how a company has disclosed its basis for preparation, or the basis of what it had in its disclosure plan. This company is Novo Nordisk, which is a Danish pharmaceutical company. It's from their 2024 annual report. And you can see that they're setting out how they prepared their reporting. So in the second paragraph, we see the different standards and regulations they took into account, including the GHG Protocol, Science-Based Targets Initiative, the TCFD, the GRI, Danish Financial Statements Act. So the reader can understand the basis on which the sustainability disclosures have been made. They tell us the time horizons they've considered for preparing information. They tell us how they've made estimates, how they've dealt with assumptions and uncertainties, and lots of other contextual information to help users understand how this company has approached their disclosure. And agreeing this in the form of a disclosure plan before you get started on reporting it to the extent possible is really helpful. Imagine having to do this all at the end of the process. That would be quite difficult. So it helps you and it helps readers of your report. Let's have a look at a quick Zoom poll now. What do you think is the answer to this question? You can only answer yes or no. Is a disclosure plan required by the IFRS sustainability disclosure standards? So you can answer yes, and you must disclose your plan, or no, but it's a very helpful tool. I know we're just slightly over time, so I'm so sorry to rush through this a bit. But now we've got a good level of participation. I'm going to end the poll and share the results with you. Well, just over half of you thought yes, it is a requirement and you must disclose your plan, and about 40% of you said no. Those of you that said no are correct, so well done. Just to clarify, there is nothing in the ISSB standards that says you must have a disclosure plan and you must disclose details of it. We've suggested this to you as homework because we think it is very helpful, a very helpful tool. Having said that, bear in mind that S1 and S2 do ask you to disclose some things relevant under a disclosure plan. For example, what sources of guidance you used for your disclosures, what judgments you made, you have to disclose that under S1 paragraph 74, what sources of measurement uncertainty you encountered, that's in S1 paragraph 78. So there are some things that the standards ask you for, but there's no requirement to have an overall disclosure plan. So there is another Zoom poll coming up, but let's have a look at this quickly. So what can a disclosure plan help a company to do? Answer all of the points that you think are relevant, to take control of its narrative, support collaboration across all the people that can help, act as a reference point and audit trail, or skip disclosure as prescribed by the ISSB. Again, because I can see you know the answer here, I'm going to end the poll and share the results. Of course, it's the first three. All of these things can be done with a disclosure plan. So well done, everybody. You got that right. And Fiona's going to take us through the Module 3 summary now.
Indeed, many thanks, Lois. So this wraps us up then on Module 3. So just taking a moment now to recap on a few key things. So firstly, coming back to connections, what we really talked about in this module is that there are a lot of connections between a company and its external and internal environment. And so these connections are what we should be focusing on when we're looking to identify and disclose your risks and opportunities. And the second thing we talked about here was relating to evaluating those risks and opportunities and being consistent in our assumptions. And this is where, if we're using scenario analysis, which can be a really helpful tool to assess resilience, it's important that we keep track of those assumptions. And so this is where perhaps using prepackaged scenario resources from some of the providers that we've shared in response to chat and Q&A comments can be helpful to give us a set of working assumptions to start with here. And then finally, as we've seen here, so even if some of this data might not be things that you're already disclosing, it could be things that you're already collecting internally for different purposes. Or maybe you're not collecting it at the moment, but you do have appropriate processes in place that you could adapt to allow you to collect that data. So as much as we can, aiming to make use of those processes and not start from scratch is the key thing here. So with that in mind, we want to take a quick reflection now in our next exercise on how building from those gaps that we maybe identified from ourselves in the last assessment, thinking about maybe with those gaps, what are the things that you might be able to draw from to help you address them? And so this could be thinking around maybe existing sources of data that you think you have that could inform your disclosures here. It could be existing processes that you have in place that you could utilize to help you with this reporting processes and risk assessment. Or it could be thinking as well about integration, as we talked about in the last aspect there. So how can you integrate what you need to do here into existing strategic processes? So let's have a quick reflect on that now together in Menti. So I see some of you are already there and responding, which is fantastic. So let's take a quick look together at your responses. Great, thanks to those who've already shared. So as I said, the question here is around thinking about existing processes or data sources that you have that could help you to collect information that you need to disclose sustainability risks and opportunities. So people have mentioned a few different things here, maybe using technology like real-time digital monitoring, using financial reporting systems, ERP systems in a bank as well, using HR systems that help you to track diversity data. Exactly, all great answers for sources that can definitely help you getting started here. Someone has mentioned as well that in their sector, in the financial industry, that analyzing the data that's needed with regard to sustainability will help you to get the data infrastructure that you need from real industry. Right, sorry, I see. So it's that connection to your real economy investees or portfolio companies that you need here. So thinking about maybe the processes that you already have on that front operationally that could be maybe adapted, or new questions and requirements that you could have to get the data you need is important. Several people have mentioned energy data as well, indeed an important aspect for calculating your emissions. So indeed looking at electricity costs or energy consumption information from operational assets would be very useful there. And the key thing I think I'd highlight here is many people mentioning using existing risk management and accounting and financial systems. Exactly, they're already set up with the right structures and processes, and the IFRS S1 and S2 standards have very much been designed to be aligned with the common types of information and process that you would have on those topics. So as much as you can, adapting and using those existing financial and risk systems is very much what we'd recommend here. See a few more useful things mentioned around internal audit and compliance information, maybe operational monitoring of your facilities, customer and tenant data, indeed, loads of great resources there. So thank you everyone for sharing that. I think you've highlighted well the point we'd like to make here, which is indeed that there's a lot that you are likely to have within your organizations that you can draw from here. So probably starting out with a bit of an exercise to map these data sources, understanding which of them are most important to have in place early in your processes will be key. And continuing to try and build up that understanding, focusing particularly on your most material sustainability risks and opportunities is what we'd recommend. Great, thanks so much everyone for sharing your reflections on that point as well. So that brings us now into our final module, number 4, on communicate, which my colleague Bella from IFRS will be taking us into. So thanks a lot, Bella, and over to you.
Thank you, Fiona. Okay, so good news. We are now on to the final unit of this training, which focuses on the when and where of disclosure of sustainability-related financial information. So, as with the last unit, we have 3 main sections. And to get us started, we will look at the location. In this section, we are looking to clarify where sustainability disclosures should be located. Okay, so before we dive into the specific requirements, let's think about sustainability disclosures in the context of a complete reporting package that is useful to investors. Investors already have access to a company's financial statements. ISSB standards are designed to identify sustainability-related risks and opportunities that complement the financial statements. These all come together in a reporting package that we call a general-purpose financial report. The requirements in the ISSB standards about what information to report are based on existing sustainability reporting regimes, focused on investor information needs and on aspects of financial accounting standards. And the GRI standards expand on sustainability metrics relevant to broader societal concerns. ISSB and the GRI reporting standards share some content requirements, like what to report, but the ISSB standards are focused only on investors' information needs and the decision-making, reflecting the mission of the IFRS Foundation, which is to bring transparency, accountability, and efficiency to capital markets around the world. And both organizations take different approaches to defining materiality, but they are not competing. The GRI approach is set out and understood among sustainability practitioners, while the IFRS approach is familiar to accountants and relies heavily on management judgment, which is aligning with existing corporate risk management processes. So together, these frameworks enable companies to meet the growing demand for transparent, consistent information across financial and non-financial dimensions, aligning both investor priorities and broader societal expectations. A simple example is where a double materiality assessment identifies that some of the company's impacts may also create sustainability risks, which could be so significant that they are important to disclose to investors. Okay, so what is material information? So as we just noted, materiality has different definitions for different reporting standards and audiences. So let's briefly recap what we mean by material information for the IFRS. In identifying material information to be disclosed, a company will first need to identify the sustainability-related risks and opportunities that could reasonably be expected to affect its prospects. Once the company has identified those risks and opportunities, it can then determine what information to provide about those risks and opportunities. This is where our materiality definition comes into play. The definition of material information used in S1 is based on and aligned with definition found in the IFRS accounting standards. It is information that, if omitted, misstated, or obscured by other information, could reasonably expected to influence investor decisions. In other words, the ISSB standards seek to identify disclosure of key information that matters to investors. An entity determines what constitutes a sustainability-related risk or opportunity based on its facts and the circumstances. Entities often have well-established process for identifying, assessing, and responding to sustainability-related risks and opportunities as part of the management of their businesses. Okay. So investors have asked for disclosure of material information, and the ISSB standards have been designed to help you gather and disclose it. However, this means that a company doesn't need to disclose information that is not material, even if the ISSB standards include it as a specific requirements. So just remember to ensure material information is clearly identifiable and that you use plain language. And also remember to ensure material information is not scattered across your disclosure. And finally, remember to include any additional disclosures if required by regulators, but ensure it's clearly identified as such. In November of 2024, the IFRS has also released further education material providing guidance for companies on identifying and disclosing material information on sustainability-related risks and opportunities, which we encourage you to look at for further detail. Okay, so now it's time for a Zoom poll. Okay, so the question is, information should be disclosed in the annual report when applying SSB standards, if admitting that information could reasonably be expected to influence investors' decisions, and if it could reasonably be expected to affect the entity's cash flows, and if it exemplifies the values of the leadership team. Okay, so let's wait for a few more seconds. Okay, so it's already 40% participation. Okay. Okay, so I'm going to end the Zoom poll now and share the results. Okay, so well done. Most of you have chosen the correct answers. So the correct answers are A and B. So the first choice and the second. So for the last choice, unless it has been determined that the particular values being exemplified as expected to have a financial effect on the company, this may not be the information that is necessary. So just remember that the definition of materiality and also the materiality assessment process for your further details and further discussion on what to disclose and what is material information. Okay, so let's continue. Disclosure under the SSB standards has to accompany the financial statements and be part of the same general purpose financial reporting package. But as one doesn't say where in that reporting package the information shall be provided. This is designed to allow jurisdiction-specific requirements on the location of reporting. The most important factor to consider here is to ensure that sustainability disclosures are provided as part of the same reporting package as the company's financial statements. Sustainability disclosures must be provided at the same time as the related financial statements, cover the same reporting period as the financial statements, and authorized by the same body or individual authorizing the financial statements. Research by WBCSD on the state of integrated reporting shows that nearly 2/3 of companies continue to put sustainability information in standalone reports. However, the SSB standards require material sustainability-related financial disclosures to be included with the general purpose financial reports. This suggests many companies have some way to go to get their internal processes and disclosure plans aligned. Okay, so now is time for an example. Over to you, Lois.
Thanks, Bella. Yes, and this example is from Ayala again, the Philippines-based conglomerate company. And those of you that use integrated reporting might find this diagram familiar. It's based on the integrated reporting model where the value creation framework is represented by inputs of different types of capital, financial, intellectual, human, social, and relationship, and shows the value generated from the value creation process. But in terms of communication, this company has used the integrated reporting framework, if you like, as a communication device. But on a very practical level, you'll see that page references are given in the middle orange circle so that we can see where there is information about outlook, material topics, stakeholders, strategy, and business activities. And as well as telling us about where we can find information on page numbers about different parts of the value creation model, they also cleverly use icons to link and connect different types of information. So if you look under strategy in the light orange circle right in the middle, you'll see that the same icon, the little skull with the wheel inside, is used under focused execution in the right hand column. And this shows us that there's a link between the value generated and what we see about information on strategy in the page numbers given. So, as Bella said, there's lots of different ways in which communication can be set up, but this particular company has used the integrated reporting framework as their main model for showing where information is and how it's linked and how it's set within the context of the value creation mechanism. Back to you, Bella.
Thank you so much, Lois. Yes, after the example, let's spend some time to look at the SSB taxonomy. Yeah, technology is an emerging consideration for disclosures. So the IFRS Foundation has created the SSB taxonomy, which reflects the requirements and the accompanying materials of the SSB standards. So the taxonomy doesn't introduce any new requirement. A digital taxonomy provides the common elements or tags needed to make your sustainability disclosures machine readable. This makes it easier to take large data sets like information from an entire industry and bring them all together to analyze them. Okay, so following the discussion on location and the timing, let's now think about ensuring efficient disclosures. We added this to the training because a common comment we find from companies is that there is a growing reporting burden. What we hope to highlight is that when done correctly, efficiencies can be made to reduce that burden. Okay, first of all, it's important to understand what effective communication looks like and what is required. Often companies think that if they just put all the information they have into a report, then everyone will be satisfied. However, this would be against the core concepts, in particular, fair presentation. For example, it could be helpful to ask these questions. First, is the information clear and concise? And the clear means it might depend on the nature of the information. For example, whether it could be clearer to present information in tables, graphs, diagrams, plus accompanying text. And what we mean by concise? To be concise, disclosures need to avoid boilerplate information, unnecessary duplication of information, and to use clear language. Okay, so in terms of the quality of information disclosed, so maybe some preparers watching today might be thinking to themselves that they still don't see what all the fuss is about. Perhaps their experience focuses on standalone sustainability reports, or they haven't had much interaction with external audit. And to the accountants watching, be kind to your colleagues, help them understand the difference in rigor that is required in data collection, oversight, sign-off, etc., for financial statements. So this means, for example, disclosures include comparative information and are to be restated as necessary. And disclosures avoid unnecessary duplication and cross-reference is required. And also information has to be material, be connected, and aggregated or disaggregated appropriately. Yeah, as you may have already noticed, there may appear to be some overlap in the disclosure topics. For example, you might have the same governance approach for all sustainability issues. Rather than duplicate certain information, you can use cross-referencing to enhance efficiency of your disclosures. And cross-referencing to other reports is permitted as long as the other report is available on the same terms and at the same time as the sustainability disclosures. The cross-referenced information is assumed to become part of the reporting package. And the cross-referencing shall be applied consistently and transparently. It shall not result in the information becoming more difficult to understand. So on the next slide, Lois will go through another example for all of you.
Yes, and this example is about cross-referencing, as Bella's just explained. It's from the 2024 sustainability report of ArcelorMittal, which is a steel manufacturing company. And if you look at the left-hand column here, content, elements, and concepts, lots of these words will now be very familiar to you: governance, risks and opportunities, strategy, performance, basis of presentation, etc. And what the company has done is they've taken the IFRS content, elements and concepts, listed them on the left-hand column, and in the right-hand column, they're saying where you can find information, where they have cross-referred to information. Now, in some cases, they cross-refer to parts of the sustainability report itself. So under business model, they refer us to the business model section of this 2024 sustainability report. So it's within the same document. In other cases, they refer us to reports outside the sustainability report. So for risk management, they refer us to the company's Form 20F, which is a US registration document that they're required to complete. And also in strategy and resource allocation, you'll see they're cross-referencing within the sustainability report, but also out to the annual report and the 20F. So an example of how a table is being used for cross-referencing there. And with that, I'm going to hand back to Bella.
Thank you, Lois. Okay, so now let's continue with the mechanisms that support adoption. Yes, we have sought to apply a number of mechanisms to support preparers get started with SSB standards. And one simple thing put in place was to adopt well-known terminology and concepts familiar to preparers, borrowing from IASB, for example. And also many requirements in S1 and S2 are to be applied proportionately, recognizing companies will have a range of capabilities and the preparedness on these issues. For example, qualitative scenario analysis is permitted, and you will see the phrase all reasonable and supportable information at the reporting date without undue cost or effort, or commensurate with skills, capabilities, and resources in a number of places. And also the reliefs for the first year provided in the SSB standards, like climate first, followed by the other sustainability disclosures, and the later reporting, and the scope 3 not required, GHG protocol, etc. So I'm not going to go through the details. And finally, we've already mentioned a number of other sources of guidance and resources, including SASB standards, CDSB framework application guidance, among many others. And these reliefs are designed to enable companies to put in place reporting practices and structures to provide high quality, decision useful information. And also jurisdictions will decide when to mandate adoption, but the standards are effective from the first day of 2024, and we know many companies are now preparing to adopt them voluntarily. Okay, so it's time for another Zoom poll. So this is about information disclosed in accordance with SSB standards should be, yeah. So there are 4 options to select from. So I can see the Zoom poll launched. Okay, so just select all the correct answer that apply. The first one is decision useful, the second one material, the third one is misleading, and the fourth one, okay, is comparable. Okay. So we now have more than 40% participation. So I'm going to end the poll and share the results. Yes, well done. I don't think I need to explain more about this question, and almost all of you have chosen the correct answer. Yes, the correct answer is all but option C. Misleading is not the correct answer. Okay, so let's. Oh, did I skip another Zoom poll? Okay.
Let's move ahead,
So
Bella, if that's okay.
Okay, sure. So let's go through the final section of our last unit. And we will look at how you can ensure that the users of financial reports have confidence in the data you are disclosing, as trust is an essential component of sustainability-related disclosures, and increasingly so with the growing concern over greenwashing. Yes. And an important trust builder is showing data and trends over time. This is why SSB standards ask for comparatives. And comparative information provides context, helps to indicate progress, and underpins strategy and risk management. And metrics disclosed by a company might be redefined or replaced over time, or the company might change its method for estimating a metric. In these situations, it's important for the company to revise the comparatives to enable investors to compare and analyze current period figures with the relevant prior period figures. And also, occasionally, a company's sustainability disclosures might contain material errors. In this situation, the company is required to restate these errors in the comparatives provided. And also, revisions or restatements are necessary only when there is a risk that material information being omitted, misstated, or obscured as a result of not revising or restating the comparatives. And finally, information can be qualitative and quantitative. Okay. Finally, it's important to build confidence by providing clear statements of compliance. A company that complies with all requirements in the SSB standards, even though about the transition reliefs, is required to make an explicit statement of compliance. We also published further guidance on this in September 2024 called Voluntarily Applying SSB Standards, a guide for preparers. Okay. So the last page of this unit, a few things to remember. So there are 3 parts. I'm not going to go to the details of every part, but just ensure information's characteristics and ensure that information can understand connections, the 3 aspects of connections, and also a few more things to remember. You can find in the handout slide deck an additional slide in this section with reminders of how to report effectively. I highly recommend reviewing that. Okay, so over to you, Fiona, for the final part.
Great. Thank you so much for that, Bella. Much appreciated. So, as Bella tells us, that brings us to the end now of our 4th and final module. So, a big well done, everyone who's still here with us. We know we've covered a lot, so let's wrap up now on our final module and on the training overall. So firstly, recapping what we discussed in this module, we talked about where to report information, and what we want to highlight here was the audience, or who you're reporting to. So making sure to be clear from the start who the primary user of information is will help you ensure that that information is right for their needs. And then we discussed efficiency. And I think a key takeaway that we hope you leave with us here is that less is more. So our objective here isn't to overload investors with information, because actually that could be harmful because it could obscure the information that is required. So this is where using the standards as you get started can be a good way to make sure that you're providing the information that investors need, which of course is the overall purpose of the ISSB standards. And finally, we discussed report user confidence. And especially in the current climate of greenwashing accusations and potential legal battles over public statements, you want to ensure that the data you're providing is not only accurate, but that you're presenting it in a way that is helping to build confidence among report users. And so that's where the disclosure reporting plan that we've been discussing and building through the exercises we've talked about today, and which you can continue to develop through the homework exercise if you'd like to, will really help, because if you have that clear disclosure plan that clearly documents your processes for reporting the data, then that's going to give you that structure to ensure that you're being transparent and building trust with your stakeholders. All right. So I think in the interest of time, and make sure we get time to talk to you about your certificates and important bits, we'll skip our final Menti exercise. And that was just a quick question to get you to share with us your reporting techniques and tips for what you think works most effectively. But feel free to share any of those in the chat if you have thoughts on that topic. But otherwise, hopefully we've shared a few tips in the materials that Bella took us through there that can help you on this. But the final Menti question that we would love you to answer for us is a quick reflection on those learning objectives that we started out with at the beginning of the session, and just to get an update on where you think your understanding is at now against those core areas we were aiming to cover with you today, which were around explaining to your team members what the ISSB is, about using the standards themselves, and about developing a sustainability reporting strategy. So whilst I'm sure this is just the beginning of building our learning on this, we won't be able to solve it all today. We hope we've been able to help move things forward a little. And I think certainly from where we were before, where I know we were in the 2s average for everything, we're now up into the 3s and a little bit further past the midpoint of the scale into a bit more comfortable than not. Overall, that's fantastic to see. So thank you for sharing. Of course, we know that this is just the beginning of learning more about this, and there's a lot to cover. So to wrap us up, I'll just cover a little bit now on some of the things that you can take away to help you continue to build your understanding. So the first thing just to come back to you and highlight is our homework assignment. And as a reminder, this isn't mandatory and it's not something you need to submit to us, but it's something that you can take forward if you'd like to continue to build from what we talked about today. So you'll find that homework assignment on the event web page, which we'll share with you again in the chat, and we've shared a number of times. That page is where you can find the slide handout, the recording of today's session will be added there, and the homework assignment. That homework assignment, as I said, is really about continuing your learning journey, taking forward what we've talked about today through some exercises that you can use to develop out your structure with your colleagues. So encourage you to take that away to complete in your own time, if that seems like it will be helpful. And there's a number of key hubs that we'd like to point you to that collate a lot of the resources and links that we've shared with you in the chat and in the slide handout materials. Firstly, we have the IFRS Knowledge Hub. So this is regularly updated with resources and is something that we definitely recommend continuing to refer to for the standards, their accompanying guidance, and some of these additional educational materials that the IFRS team have developed. Another thing that might be particularly useful here is that the IFRS in June launched 4 free e-learning modules to support ISSB adoption as well. And so these are self-paced, interactive knowledge checks, and they also offer a completion certificate like we have in today's session. So a good thing to continue to strengthen your practical understanding and perhaps to share with your colleagues as well, maybe sharing with them the most relevant module for their particular involvement in the process, for example. And then, as Kate from the IFC explained to us at the start of the session, the IFC also provide many resources on these topics which can be helpful. So encourage you to refer to the Beyond the Balance Sheet program from the IFC, which has developed a lot of resources, particularly to support action in emerging markets on corporate governance, sustainable finance, and more. So please take a look there as well. A final mention of the SSE toolkit, which we've talked about a number of times, but just to know that that is there as well. And particularly, I think the gap analysis checklist and model guidance on sustainability related financial disclosures can support you in the how-to and internal implementation of what we've talked about today. So with that, we want to say a big thank you and well done for all of you who stuck with us throughout this full half day of training together. We know that this is a long time and a lot to ask in the online environment. So we're really appreciative of all of you who've asked questions and engaged with us and interacted throughout this session. It's been fantastic to see such engagement and participation. So as a big thank you for that hard work, you're now able to receive a completion certificate for taking part in the course. And that has CPD credits attached for those of you who have a professional body membership to get CPD certification as well. So to get your certificate, what you will need to do is fill out our feedback survey. And of course, we love to hear your feedback on the programme as well. So the first way you can do that is by following that link to the feedback form that Lois has shared with you in the chat already there. The second way will be an email will come from Zoom tomorrow, and that will reshare with all participants who joined us the link to that survey as well. So once you take part in the survey, please give us around a week to receive your completion certificate. We send those out weekly, so keep an eye out and we'll get a certificate out to you in the next week. I would say if you know that your organisation has quite strong spam filters, to make sure you check your junk folder in case the certificate has gone there, or maybe try using a personal email address for the survey as well, and that just makes sure that your certificate gets to you. But if you do have any issues with that, you can contact the SSE team and we'll be happy to assist you there. So before we close out, a big final thank you and a few words of appreciation. Firstly, to the SSE's official supporters who support and make this programme possible. And a big thank you especially to the team at IDX, to Ronnie, Tuku and others who've supported us in organising and hosting you all together for today's training. A big appreciation for that. And of course, last but not least, a big thank you to our partners at IFC and the IFRS Foundation, particularly Robert and Bella for joining us today and their support in answering all of your questions in the Q&A as well. And finally, of course, a big thank you to everyone who's joined us here in the session. We hope you have a fantastic rest of your day and hope to see you again at a future SSE training session. So we'll close the session there, and thanks all for your lovely reactions in the emojis as well. That's always great to see. So enjoy your rest of your day, and thanks again, everyone. We'll end there. Thank you.